सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामर्षो निर्विमाणः तदेव शुक्रं तदेव
आदित्य, वो लिंक भेजेगा अभी कोई, तेरे को ऑथराइज करना पड़ेगा, तो रह जाएगा। और 11:15 को फिर बंद कर देना एंट्री भी, सिक्योरिटी रीजन के लिए।
अभी भी कितने लोग भेज रहे हैं?
50 आए अब तक तो।
इधर तो आ चुके हैं, मगर अभी भी लोग मैसेज कर रहे हैं कि नॉट रिसीव्ड।
हाँ, नॉट रिसीव्ड, कंटिन्यूअस मैसेज आ ही रहा है। नहीं, बट लोग ज्वाइन भी हो रहे हैं साइमल्टेनियसली, दोनों बाजू। That is the irony. People on one side people are telling not received, और दूसरी बाजू ज्वाइनिंग भी हो रहा है। 51 तक तो पहुंचा है।
Just a video of 2 minutes of Google on code of ethics. Just start in 1 minute.
हेलो, हाँ भेजो।
आदित्य, आदित्य म्यूट है.
ठीक है, टेक्स्ट करो. Thank you all for a Thank you all. So today's topic is important issues on capital gains and recent judicial pronouncements. A lot of us face problems in day out, like what is the issue, what is a transfer, not a transfer, whether this is a capital asset or not a capital asset, and what could be the probable issues. So we have CA Piyush Chhajed who will take us through this, who will guide us through the presentation and various issues which arise in our day-to-day activities in practice. And also, he's a regular member. He's regularly coming to AOSC, and is like a second home, you can say. So he does not have an introduction, but as a matter of protocol, I will request CA Utkarsh Sharma to formally introduce the speaker.
Thank you, Aditya. CA Piyush Chhajed is a BCom FCA DISA and currently partner in Chhajed and Doshi Chartered Accountants based in Andheri East, a firm established in 1964 by late CA SP Chhajed ji, past president of ICAI. He specializes in direct and indirect taxation and arbitration proceedings. He cleared his CA in 1999, has done his articleship from V. Sankar Iyer and Company. He is a regular speaker on various topics of direct tax, service tax, and now GST. He is currently co-opted member of Central Council Committee of Strategy, Perspective Planning and Monitoring Committee of ICAI. Again, a co-opted member of Direct Tax Committee of WIRC of ICAI for the year 2021 and was a member of Direct Tax Committee of Chamber of Tax Consultants for the year 2019-20. He is also a member of the Reserve Bank of India Asset Reconstruction Companies from 2019 onward. He's been a special invitee on Central Council Committee of Direct Taxes of ICAI, co-opted member of Central Council Committee on Government Accounting of Board of Studies of ICAI, co-opted member of Central Council Committee of ICAI 2004 and 5. He's also been a subgroup member of Journal Committee, Career Counseling Committee, Capacity Building Committee, CPE Committee, and Professional Development Committee of WIRC of ICAI. He's currently honorary Vice President of Jain Chartered Accountants Federation, Mumbai, Honorary Joint Treasurer, Shri Vijay Himachal Surji, Kirti Stambh Ghanerao, Rajasthan, Trustee Shri Vardhaman Jain, Govindpur Samiti Teerth, Rajasthan, Jayabhai Memorial Trust, and Shri Ju Lane Jain Sangh. I welcome him on behalf of Andheri Oshiwara Study Circle.
Yeah, after listening to this present introduction, where does he get time to practice? It's a very big question also. So over to Piyush. Thank you. You can start screen sharing your presentation on this screen.
You, sir.
So you are not audible.
Audible.
Or the voice is low?
No, it's better. Perfect.
Okay, fine. So thank you, Utkarsh Sharma, for introducing me. Thank you, Aditya, Anishka, all the committee members of Andheri Oshiwara Study Circle. As rightly mentioned, Andheri Oshiwara Study Circle has been my home. I've delivered a lecture in physical also over there twice in last 2 years. And this year, because there was no opportunity because of COVID, so Aditya, Anisha provided me this webinar to be part of you. I thank you very much. Today's topic given to me is basically recent amendments in capital gains and landmark judgments. Capital gain has been always a matter of big interest for any practicing member because, as you know, there is a lot of tax involved when it comes to a capital gains. The regular income, business income, income from salaries, income from house property is a regular subject which repeats on year-to-year basis. But the capital gains, you keep on getting the problems, issues of different type. And if you, I will take you through during my first, I'll go through recent amendments, and then I will go through the landmark judgments, certain judgments which have changed the thought process of the even the professionals. So I will go through that also. I will share my screen and we can take the questions in the last, I think, so Aditya.
Yeah.
And if anything is there, you can also put the questions, you can mark it with the convener, and the last we can take it. I'll just share the screen of my presentation. Is my presentation visible to everybody?
Yeah.
Okay. Thank you. Capital gains, recent amendments and landmark judgments. As you know, during this last calendar year, there have been a lot of amendments. There was a budget there was initially a preliminary budget, then there was a final budget, then there was again an ordinance, and then again a budget. So if you actually compare in last year, there are 3 to 4 budgets and ordinance which have made changes to certain capital gains sections. So we will in my initial presentation, I will try to bring out the amendments which were made in the capital gains certain sections, and then I will go on the landmark judgments. The first and foremost, which is very important from an individual side of assessee, Section 54, as you know, gives the tax benefit for exemption from capital gains when you reinvestment in residential house property. Now, this Section 54, we all know as a practicing chartered accountant that if there is a capital gains and if you invest in the residential house property subject to certain conditions, you get an exemptions. Now, this conditions were that you should purchase within 1 year before or 2 years after. Construction should be within 3 years after. It should be residential house property in India. And all those conditions are since sacrosanct, except if you see the column number 4, which is residential house property in India. Initially, up till 2015, you may know that residential house property which were purchased abroad was also allowed under Section 54 and Section 54F. Only after 2015, this amendment came in, wherein the exemption was restricted to investment made in residential houses. Rest all these conditions are going since quite long. Now, if you see, earlier exemption was one residential house property purchased or constructed in India. There was an exception. If you know, there was also a dispute going on that there was a word used before that, a residential house property purchased or constructed in India. And that was a subject matter of litigations, that whether is a singular or plural. So there was certain amendment made which clarified that only one residential house property purchased or constructed will be allowed. Especially this disputes went in the case of landowners wherein they were getting the multiple units when they were surrendering the land under the joint development agreements. And there were certain judgments which came out from Madras High Court and other high courts also, that can be read as does not signify singular, it means plural also. And therefore, it should not be, cannot be treated as one. To overcome that, an amendment was made wherein a one residential house property was mentioned. Another amendment has been made in this assessment year 2021, wherein says this one residential house property amendment was made prior to assessment year 2021 for this financial year 1920, which is relevant for AY 2021. One more amendment has been made, and practically there is an option granted that you can claim this benefit in respect of 2 residential house properties if long-term capital gains is up to 2 crores. So if I sell a property under Section 54 is available, when I sell a residential property, I buy a residential property. If my capital gains is below 2 crores, I get an option that I can buy 2 residential house properties. and I can still get a benefit under section 54. So this is the amendment which has been come from assessment year 2021. Initially before that was only a one residential house property. And as I mentioned earlier to that, the word was used and a lot of codes have interpreted includes multiple units also. So we are coming from multiple units to a single unit, a one residential house property. Now it has come to two residential house properties, only to a limited number of assessees whose capital gains is less than 2 crore rupees. More important condition is that this option or this benefit can be exercised only once in the lifetime. So let's take an example. For assessment year 2021, I earn a capital gain of rupees 2 crores. If I buy a one residential house property, I'm still getting a benefit. But if I want to claim the benefit after selling a one house property, I want to claim it against the two residential house properties. This benefit can be exercised only once in lifetime. So once you have exercised this option, then in future you will not get this option. And again, for that particular assessee, the restriction will apply, which is one residential house property. So this was the amendment made during the Finance Act 2019 for assessment year 2021. Section 50C. As we know, what is Section 50C? Section 50C is a deed provision wherein the assessee sells the flat or a property or a land or building for that matter, and the value adopted by the stamp authority for the purpose of levy of the stamp duty is less than the transaction value, then the deeming provision says that the consideration for the purpose of calculation of capital gains would be treated as the value adopted by the stamp authority. So your consideration gets replaced from the transaction value. Now section 50C, again, there was some leverage given because ultimately it is an estimate. Even the stamp duty value is a reckoner value, which is based on a particular area. All buildings have a different value depending on a type of constructions, type of quality of constructions. Road facing flats have a different price. Top floors have different price. But if you go through a reckoner rate, it's a fixed rate for a whole building it is. There is some difference for, there is after a particular floor, there is a floor rise added to it. There is depreciation. But still largely, if the building is next to NATS and it was on the similar floor, you get the same value. Though a particular building may be commanding a higher market price because of the locality or because of the maintenance or whatever it is. To overcome this estimation, there was a leverage given that if the difference between the stamp duty value and the transaction value is not more than 105%, that is, difference is not more than 5%, I would say, then the deeming provision should not be applied. Now this has been amended again from the assessment year, that is through this finance bill 2020. Now this will apply to current financial year, assessment year 21-22. This 105% has been increased to 110%. That means if the difference is less than 10%, if my stamp value is 110 lakhs and my transaction value is 100 lakhs, that is 1 crore, 1.10 crores, 1.10, then that difference has to be ignored for the purpose of section 50C. So this is again a recent amendment which has happened. It has to be ignored for the purpose of section 50C. Third amendment, which is again a surcharge rates on capital gains tax. If you know, there was a lot of hue and cry happening when there was increase in surcharge rates on individuals. Because when we talk of capital gains may be from the property, maybe from the shares, long-term capital gains, short-term capital gains. And there was a change in surcharge as far as individuals is concerned. And the surcharge was increased to the extent of 37% if your total income is exceeding rupees 5 crores. Like 10%, 15%, then there was a 25%, and then there was a 35%, that is between 2 crores and 5 crores. There was a rate of 25%. And beyond 5 crores, the surcharge is 37%. So effective tax rate in above 5 crores is going almost up to 42 to 43%. Now, another amendment again made after the increase in the surcharges, that capital gains, if there is any capital gain income, that is a long-term capital gain that is under 112A and short-term capital gain under section 111A, then for the purpose of that, surcharge will be not applied. The revised surcharge of 25% and 37% will not apply. Only it will apply a maximum up to 15%. That is the slab which was applicable that for other incomes is between 1 crore to 2 crores. Surcharge is 15% maximum. And after 2 crores, it is 25%, up to 5 crores. And after 5 crores, it is 37%. But in case of long-term capital gains, your surcharge, even if your income is about 2 crores, will not exceed 15%. Long-term capital gains covered under section 112A and in case of short-term capital gains. So there is again a relief granted for the capital gains. Now there is a new section which has come, section 49(2)AG. This is very specifically for segregated portfolio. Now what is segregated portfolio? As you are aware, nowadays, supposing I am investing in a debt market and debt mutual fund, and that mutual fund has invested into 5 companies in bonds or maybe as a debt instruments, whatever it is. Out of that 5 companies, 1 company is not doing well. So the NAV goes down. So SEBI wide its circular somewhere in 2019 came that you can break that portfolio wherein the investment or the debt instrument which is bad, which is not performing well, can be segregated into a different portfolio. So let's take an example. I am having 100 units of Aditya Birla Mutual Fund debt fund. Now, that debt fund had a portfolio of 5 companies wherein a debt instruments have been acquired. Out of 5, 1 is in a problem. So the Aditya Birla Mutual Fund decides that 1 problematic investment I should hive off into another portfolio. So he hives it off. What happens is the investor gets equal units of both the portfolios. So my existing 100, which has now 4 good investments, and I get another 100 units of the bad portfolio, which is basically anti and maybe not giving the proper returns. So this is a segregated portfolio. Issue arises in income tax that when you actually calculate long-term capital gains or short-term capital gains, how the cost has to be allocated between the 2 portfolios, that is hived off portfolios. So a formula has been prescribed under section 49(2)AG that how it has to be calculated. It is basically the proportionate of the investments at the cost basis or the NAV basis. That was an issue. So NAV of the assets transferred to a segregated portfolio when compared to total NAV on that particular date when the segregated portfolio is considered would be treated as cost of acquisition of those segregated portfolio. So if I have 100 units which I bought at 1,000 rupees and the NAV is 900 rupees particular date, then that 1,000 rupees will be divided in the ratio of the NAV of the units of the fund which has been segregated into a separate portfolio. So if 900 comprises of 800 of 4 scrips and 100 rupees only of 1 scrip which has been hived it off, then in the ratio of 4:1, basically, our 1:1:8, I would say, would be your cost would be allocated as far as calculation is concerned. 54 GB. There's again an exemption provision. What does section 54 GB says? That if there is any long-term capital gain arising on account of transfer of residential house property or land, then that capital gains will not be charged to tax, or you will get an exemption if they are invested in the eligible startups. So if you bought, if you purchase, or if you subscribe the shares of certain eligible category of startups, then that capital gains will not be taxed. That new assets, subsequent to investment in those eligible assets, there will also certain conditions on those startups that they have to invest into a particular assets within 1 year from the date of the subscription to these shares. Now, and those assets which they have acquired, those startup companies which have acquired those assets from the investment made out of those 54 GB funds has to be held by those startup companies for at least period of 5 years. This was the existing provisions under Section 54G. So if I want to avail a tax benefit, I invest in a startup company, I subscribe to the shares of startup company. Startup company has to ensure it's an eligible startup company. There are a whole lot of conditions for that. It should be registered with the DIPB, eligible startup companies. It should be technology based. If you comply with that, then it falls under eligible startup. If I invest into that, I get a benefit of the capital gains, subject to that subsequent investment by startup is done within the period of 1 year into certain new assets. And those assets are held for a period of 5 years. Now, generally, the startup companies are technology companies. So, government felt that to have a locking period of this 5 years, wherein the majority of assets are IT assets, which do not have a life shelf of the 5 years, like computers, laptops. So, an amendment has been made, wherein in case the new assets are computer or computer software, this is effective from assessment year 2021, the lock-in period has been reduced from 5 years to 3 years. This is the amendment again made in the Finance Act 90. Section 50CA was brought in from 1st April 2018. When I say 1st April 18, assessment year 18-19. As we all know, as far as Section 50C was there, is in statute book since more than 10 to 15 years now. Wherein if you are selling the capital asset, which is in form of land or building, and if the value is of less than the stamp authority, then the deeming provision says that transaction value will not be considered and the stamp duty value will be considered. What was happening is certain companies whose book value or the fair market book value of the particular shares was very less, but the real value of the assets which were held by those companies were quite high. So in such cases, 50C was not attractive. So let's take an example. I have a company of 1 lakh rupees capital, and it has an asset of 1 lakh rupees, which is valued today at 1 crore rupees. So if I was transferring those shares of 1 lakh rupees, there was no provision to hit on that. Subsequently, 50CA came, and as far as buyer is concerned, Section 56 is also there, that if you buy it for a cheap, you get it back. So 50CA provision came, wherein shares, wherein if you are transferring any shares of other than quoted shares of the company, that is closely held companies, private limited companies, when the sales consideration is less than fair market value of these shares, then the full value of consideration would be treated as fair market value. So if you are selling the shares at breakup value, but the fair market value of the shares is less than the higher than the breakup value, then your consideration for those sale of shares would be replaced by the fair market value. For the purpose of the fair market value, there is a provision already there under 56(2)(10), which says that FMV is computed for determining income for receipt of such shares, which will be again now applicable in 50CA is also there. But Section 56(2)(10) gives us certain exemptions in respect of certain specified transactions, wherein like for startup companies, for venture capital funds, there is a lot of exemptions available, in which case 56(2)(10) is not applicable for the buyer of the shares. So for the purpose of 50CA, no such exemption is available. As far as calculation of fair market value is concerned, it has to be, again, you have to really, refer to 56(2)(10), which again prescribes to a rule which says that the fair market value has to be calculated under the breakup value or a DCF method. If you are calculating a breakup value, then if there is any immovable property, or is there any downstream investment in shares of some subsidiary company or associate company, then in case of the capital asset or the land or building, you have to replace those values of the land of the book with the book value, with the fair market value instead of the book value, and then arrive at the fair market value of the shares. So this is a new section which came from 1st April 2018. I thought, though it is now there from more than 2 years, but it is important because this also has taken place amendment in last 2 years, and also because now the assessments are started happening in this case, and a lot of additions will start happening when AY 18-19 assessment year comes up. Again, assessment year 18-19 amendment, again a very important amendment. Section 45, capital 5A, lot of controversy was there in case of joint development agreements or the development agreements. As you know, what do you mean by a development agreement? Basically, a landowner enters into a contract with a certain builder, a developer, for developing his property. I am a landowner. I am in occupation of a particular land. A structure may be there on that or may not be there. I entered into a development agreement with a particular builder who says that I will construct a building over there by utilizing a particular FSI. Instead of paying consideration to me in cash, he agrees to pay me the consideration in kind by way of a particular constructed residential units, commercial units, or whatever is the construction being done, industrial units, whatever. So there was a lot of issue going on because the generally joint development agreements takes place. Let us take an example. If it is happening today, the construction actually takes place over a period of 3 to 5 years, and sometimes if the projects are of a long gestation period, it may go up to 7 to 8 years also. So there was a controversy going on. Actually, when does this capital gain tax arose? When does actually a transfer takes place under section 247? Does the transfer happens when you enter into an agreement itself? Number one, or transfer actually would actually take place when actually you get the consideration in form of a constructed units. So there was a lot of issues, a lot of controversies, a lot of judgments going on. Both ways you will find a judgment. But a certain view was happening, certain view which our fraternity was also taking, that as soon as you enter into a development agreement and you give a possession to the developer for constructing a residential or the constructing any particular building thereon, then the transfer has taken place and capital gain tax has to be paid on that particular day. To rest this controversy, a section 45(5)(a) was amended with effect from assessment year 1890. It was inserted from that matter. Section 45(5)(a) is applicable only in case of individuals, HUF, who owns land in the building, and they transfer such land by way of a joint development agreement with the real estate developer. What are the features of such specified agreement? The agreement should be registered, where the owner allows the developer to develop a real estate project on such land building or both. Consideration is payable by the developer in the form of share in the developed land or building. As they say, it should be in the kind. So these are the features of 45(5). When would be the actual taxability happen in this case? It would be taxable in the year in which the certificate of completion for whole or part of the project is issued by the competent authority. So now, irrespective of going into a transfer, 45(5)(a) says that if you have entered into such an agreement where you are getting in-kind consideration by way of the constructed units, when you get the constructed units or when the completion certificate in Bombay, I think so we call it occupation certificate. It is a certificate of completion that particular building has been completed either in part or whole. Whenever that first certificate of completion has been issued in the favor of the developer or maybe the landowner in certain cases, on that particular time, the taxability will arise under 45(5). So it actually gives a lot of concession, lot of benefits. It actually reduces a lot of disputes that were happening between the landowners, developers, that as soon as I enter into agreement, I don't have money to pay taxes today because it's a total agreement is in kind. There is no cash receipt, so how to pay taxes thereon? So this has been clarified by way of 45(5). How do you compute the capital gains in the hands of owner of land entering into JDA? It says stamp duty value of his share of land building on the date of issuance of completion certificate plus cash consideration if any. Because the consideration is in kind. So supposing I am getting 1,000 square feet flat in lieu of the land which I have given for the development, then I have to add up the stamp duty value of that particular 1,000 square feet. And I will add by cash consideration if any. If there is no cash consideration, then only this stamp duty value. That is for the purpose of computation of numbers. What happens if the landowner transfers his shares before his issue of completion certificate? So I have been allotted 1,000 square feet under this agreement, but I enter into an agreement with some third party. Then whatever 1,000 square feet I would be getting from the developer, I sell it to the third party. So what happens in that particular case? In which case, it really clarifies that the benefit available under 45IA would not apply. And you would be taxable in the date when the transfer takes place immediately. So let's take an example. I get 1,000 square feet. So from the land I have, when I entered into a development, I got 1,000 square feet residential flat. It's purely an allotment letter because there's no possession given. There's no completion of project. Pending the completion of the project, I sell this 1,000 square feet, those rights in 1,000 square feet to somebody else. So what happens to the capital gains at the first level when I've got the residential flat on transfer of this particular land or on conveyance or under the development agreement? This which was taxable on the date of completion certificate will now, the taxability will actually be preponed on the date when actual transfer takes place. So you will tax it on number one. Now this 1,000 square feet, as far as the computation of capital gains is concerned, is taxable in the on the basis of stamp duty value of the land or building on that particular date from the land. So that is the consideration for the land. It may happen that you may receive some more amount for selling this residential flat also. The transaction value may be more also. In which case, a transaction value would be taxed to that extent and not the fair market stamp duty value. Related amendment has been also made in new section 49(7), which talks of cost of acquisition. As I said, what would be the cost of acquisition? Supposing I get a completion certificate, I take a possession of the flat, I pay one particular tax on that particular date because I've sold land, I got a residential flat, so I pay a capital gains tax. When I actually sell that flat after holding it for another 1 year, 2 years, what would be the cost of acquisition? So similar amendment has been made. Whatever was the consideration treated under 49(5) by, that is the stamp duty value of that particular unit or particular residential, whatever it is, that would be treated as cost of acquisition of that constructed unit when I actually sell it. Related amendment has been also made in respect of 194 IC in respect of deduction of TDS, wherein 10% is applicable. Amendment in 47(7) AB. Finance Act 2018 has amended 47 AB. What is, if you would have heard that there is an international financial service center which has come up in Gujarat. We are in Mumbai, we would have read in newspapers, Maharashtra government was trying to bring this IFSC in Mumbai, but IFSC has already come up in Gujarat, which is named as a gift city. Now this gift city is as good as an offshore land, as good as an SEZ, or any entities which are incorporated in IFSC are actually in nature of offshore entities. When I say it is in nature of offshore entities, that means they are not in India. They are a non-resident entities. They are not taxable in India for all their businesses which are done, which are in nature of export from an IFSC sector. So there were a lot of issues, a lot of tax, what happens to their investment income. So an amendment was made in section 47(7), which says if the non-residents makes any transactions in particular assets on a recognized exchange located in IFSC. So if a stock exchange is located in IFSC and I am a non-resident, non-resident for the purpose of IFSC also includes entities which are located in IFSC, please mind it, shall not be regarded as transfer if the consideration is paid or payable in foreign currency. IFSC does the business only in the foreign currency. All the banks which have come up in IFSC are doing the business only in the foreign currency. So if the transfer of the particular assets is happening in the foreign currency between a non-resident on a recognized stock exchange situated in IFSC, then there won't be any tax. So this amendment has been brought. It has a very limited implications because if you see the international financial service centers, only 3 type of major entities are allowed over there, which are into financial services. Those are banks, NBFCs, then stockbrokers, and investment bankers. So it's applicable for Related amendment has been also made in section 10 that if those particular fund which have been incorporated in IFSC and if specified funds, because there would be a funds like alternative investment funds, venture capital funds are been invited into IFSC, if they are incorporated in IFSC, and if that fund earns any particular income which is in nature of 47(7)(ab), then also those income would be exempt under section 10(4)(d). So what do you mean by the fund? As I mentioned, it's an AIF category 3. Then we had a venture capital funds. We had any trust company, LLP bodies incorporated in IFSC, and they are running particular fund. Then all those incomes which are in this nature of 47(7)(ab) would be exempt. Section 54(EC). As we know, if there is any capital gains, and if we invest in a particular bonds, then there was an exemption available under section 54(EC). There are very two important amendments which has happened in this particular 54(EC) from assessment year 1920, which I don't know whether most of us realize or not in our daily practice. If you see, 54(EC) was available for any capital asset initially up to assessment year 1920. Now the words after the amendment has been used as land, building, or both. So if you have any particular capital gain from an assets, let's take an example that you have a capital gains from the sale of shares of a private limited company. Hitherto, I was having a benefit under section 54(EC). If I invest into a particular bonds, I was getting a benefit from assessment year 1920. Now this benefit of investment in the bonds is available only if the capital gain arises on transfer of land, building, or both. Furthermore, those bonds, instruments in which we are investing, were for the period of 3 years. Now these bonds are redeemable after 5 years. So the locking period of your funds in those bonds have been now extended from 3 years to 5 years. So these are the two major amendments. As we all know that there is already a limit of 50 lakhs. There was whether 50 lakhs would be per financial year or it would be a per transaction was of dispute. Various tribunals and courts held that 50 lakhs has to be paid per financial year, which was already amended that 50 lakhs would be now per transaction. So if I have a capital gains which have accrued to be in month of March 20, initially before amendment, I could invest 50 lakhs in March because that is also within 6-month period, and I could have invested another 50 lakhs in April and I could have taken the benefit of 1 crore rupees. Now this has been amended. Maximum benefit will be available only to the extent of 50 lakhs, irrespective of the financial year in which you are investing. Conversion of stock in trade into a capital asset, as amended by Assessment Finance Act 2018 with effect from assessment year 1930. On conversion of a stock, amount taxable as a business income under 28(6)(a) at the fair market value of inventory as on date of its conversion into capital asset. Now I'll give you an history of this. If you all recollect, a lot of landowners, developers, and even the share market investors used to acquire their capital asset and held as an investment for a long-term period. And whenever they decided that I need to now trade into those stock and shares, I need to trade into land or building, I need to go into a development, they used to convert that capital asset into stock in trade. So on conversion from capital asset into stock in trade, there was a capital gains tax chargeable. So, but there was a deferment of tax. Till the time you didn't sold stock in trade, there was no tax payable. So if I convert a capital asset into a stock in trade, say on 1st April 2018, the value of capital gains on the capital asset on that particular day is 1,000 rupees. And the long-term capital gains is 900 rupees. But I didn't have to pay tax on that. Ultimately, after conversion, I used to sell this stock in trade maybe after 1 year. For of this 1,000, I used to sell for 1,200 rupees. So there were the two workings which was done. Amount, value of the capital asset on the date of conversion was chargeable, and the capital gains, that 900 rupees was chargeable as a capital gains tax. And the balance amount which has accrued, or 200 rupees which you have earned in the valuations over a period of 1 year when it was held as a stock in trade, was taxable as a business income. So there was a provision, so you were not paying tax. Now a new section has been brought in to tax it. An amendment has been made under section 2868, wherein income now includes in its definition that any amount which is accrued on account of conversion of stock in trade into capital asset. Now I have a certain stocks, shares, which I am holding it as a stock in trade. And when I acquired, I thought I will hold it for 2 months period, 3 months period, because I'm also a trader, I am also an investor in the share market. So I buy it as a stock in trade. And ultimately I decide that in the short term, it's not giving the returns. Now my perspective changes. And I think that this investment, I should hold it for a long-term period with more than horizon of more than 1 year. So I convert this stock in trade into a capital asset. So when I sell that particular shares, I don't have to pay tax, or I pay tax now at the lower rate. So initially there was no tax, there was no provision in the law for taxing those stock in trade in the conversion of capital asset. Whenever I used to sell capital asset, my cost minus my capital gain, working was been done, and I used to pay a capital gain tax. Now 28.6 says that on the date of conversion, whatever is the value of that particular share, fair market value, if it is quoted, you get it from the stock exchange. If it is not quoted, you have to work out fair market value. Whatever is that price, it would be taxable on that particular date as if you have sold the stock in trade. Irrespective, it's a notional entry. You are not actually receiving any cash, but it will be taxable. Obviously, whatever amount is taxed or whatever is the fair market value on that particular date, which is treated as consideration for stock in trade, would become a cost of acquisition as far as capital asset is concerned. And when you sell it, you will get a benefit of that cost of acquisition. So this is the new amendment, which was again brought from assessment date 1920. There are certain tax rates. I have just summarized what are the tax rates in the capital gains equity, because there are a lot of amendments keep on happening. Long-term capital gains, as we know, equity-oriented schemes up to financial year 18-19 were always exempt. Now it is taxable at 10% if your capital gains is more than 1 lakh. We got some grandfathering provisions also, but now it is taxable at 10%. Then other than equity oriented schemes, they were taxable at 20%. You used to get a benefit of schemes. Short-term capital gains, equity 15%. Other than equity, it's a slab rates. So these are the tax rates which are applicable for 1920, 2021. So I've just got it after all the amendments which are made during this 2-year period. Similarly, for the similar rates is applicable for domestic company and firm, except in case of short-term capital gains, where the maximum marginal rate they used to pay was 30%. Now, based on the companies, they may be paying 30%, 25%, 15%, 20%, whatever they are opting for. Because as you know, the various companies have the various tax rates applicable to them. So maximum tax rate applicable if it is a 22%. From 2021, then definitely from 1920 financial year. So they can, even the short-term capital gain will be taxed at 22%. Again, short-term capital gains, as far as other than equity-oriented schemes, you get indexation benefits. As far as equity-oriented schemes, there's no tax indexation, you pay directly 10%. NRI's taxation, again, more or less similar tax rates. Other than equity oriented schemes, maximum slab rate again 30%, and it's more or similar. This is for your information, because these amendments have taken place. There's a change in tax rates. That's why I thought it would be important to bring it. In case of NRI investors, there is a TDS applicable. TDS applicable is again actually the TDS rate is similar to what is the tax applicable rate to NRIs. So it's a similar tax rate wherein the TDS has to be deducted in case of NRI investors. So these were the major amendments which I tried to cover. These amendments which happened between assessment year 18, 19, 19, 20, 2021 and 21, 22, last 2 years. I would now go section by section and try to discuss various important judgments in capital gains. Certain judgments may be of useful today, may not be useful also today, because certain judgments have been overcome by way of the amendments made, as we had discussed earlier also. So I would go into the judgments, very important landmark judgments according to me. The first issue which I would like to cover up is judgments in relation to exemptions been claimed under the capital gains, under section 54, section 54 EC, section 54F Now, we all know that there was a lot of controversy. If, let's take an example, father sells his asset or any capital asset or a residential house property and he earns some capital gains. The question arose, and he wants to buy the new residential property, maybe in name of his wife or in his name of son. Then there was an issue, there was a controversy going on, and there were two views also possible. That whether that new residential property should be bought in the name of the person, the assessee, who has earned the capital gains for claiming the benefit under section 54, 54F, etc. Or he can buy it in the name of his wife, his son, his close relatives. There is a judgment of Delhi High Court, wherein a particular assessee invested the sale proceeds into new asset in the name of wife. So, wherein it was held that he will be still granted a benefit of section 54. What was the important point in Delhi High Court says? That ultimately this is a benefit granted which has to be legally interpreted. And as per the liberal interpretation and the objectives of section 54 was that whatever capital gains is accrued is reinvested, deployed into a real estate, that is residential flats. And that was the objective, irrespective in whose name it is. Considering the total today's scenario, wherein generally when the generations keeps on changing, a lot of fathers intend to sell the properties and intend to buy the new properties in the name of their son or their wife for the security purpose. So there was no reason or there was no restriction per se in section 54 or 54F that it should be bought in the name of the assessee who has earned the capital gains. So even if it is not bought in the name of the assessee, still the capital gains will be allowed. That's what Delhi High Court says. In our regular practice, this issue keeps on coming and we have been put with the questions. Obviously, to my mind, your assessing officer will not accept it today because there is no Supreme Court yet on this particular issue. There are high courts, other high courts also there other than Delhi High Court, which have ruled in the favor. But the question that arises is, what should I do in such a scenario? Generally, what I would suggest is that when you are buying an asset, obviously the important point is those funds should be utilized. If the funds are the similar, like if the father is earning the capital gains and he uses those funds for buying the asset in the name of his son or wife, or he transfers into their bank accounts, they pay the same funds are being utilized, then you should not be denied the benefit of 54F. That's it. As a matter of abundant caution, you can always use the joint names. A lot of people are doing that. They use the joint names. But even in the joint names, there is a difficulty because if tomorrow some unfortunate incident happens and if seniors are not available, then you always have to go through a process of legal succession. And therefore, you can always have this judgment to a rescue when you can actually buy the property in the name of your child, your relatives, if the funds are similar. The Delhi High Court supports you. There's another judgment of Punjab and Haryana High Court. This is in respect of when you are acquiring any particular asset for the purpose of taking the benefit under section 50. An LOT, if you see under self-financing schemes, an LOT gets title to property on issues of an allotment later and payment of installments is only a consequential action upon which delivery of possession flows. Therefore, right of assessee prior to date of delivery of possession was the right in property, and even prior to said date, assessee was holding said flat. Therefore, capital gain arising on said flat was a long-term capital gain, and consequently, assessee was entitled to set off the same under section 54. So, question is, even if there is an allotment later is right, there is no possession been made. Even if you sell it, it would be treated as long-term capital gain from the date of allotment without getting the possession of it. And therefore, once it is a long-term capital gain, you are entitled to benefit under section 54. So, even the right to acquire a flat should be held more than the holding period limit. So, if the holding period limit is 2 years, for an example, the right should be held for the 2 years. If the right is held, irrespective you actually get the property or a residential flat or not, irrespective, your long-term capital gains will be worked out from the date of allotment. And if you have actually 2 years are completed from date of allotment, you get a benefit of the capital gains. (54)EC. It's a very important judgment of Supreme Court Depot Company. Assessee is entitled to exemption under Section 54C in respect of capital gains arising on transfer of capital asset on which depreciation has been allowed. Now, this is very important because the way I know, we were always thinking, there was generally a thinking process that whenever I am claiming any depreciation on a particular asset, then the dimming provisions of Section 50 applies. And therefore, the block value of that particular asset is reduced from the consideration, and the total difference is taxed as short-term capital gain. And once it is a short-term capital gains, I do not get benefit of any provisions of Section 54, 54EC, 54F, or whatever it is. I cannot avail those. What does the Supreme Court say? That the Section 50 dimming provision is only for the purpose of imposing of tax rate, that it would be treated as a short-term capital asset only for the purpose of Section 48. But ultimately, if that depreciable asset has been held for the more than 36 months period, or now it is 24, whatever it is, it would be still available. It would be still treated as a long-term capital asset. And once it is treated as a long-term capital asset, you will be eligible for exemption under Section 54F, 54EC. So if I sell a depreciable asset and I have a capital gains which we use to classify as a short-term capital gain, then also I can still invest into particular bonds under Section 54EC. So if I sell a factory building, which I have claimed the depreciation, and the consideration is more because the book value has already gone down after claiming the depreciation, I can still claim a benefit under Section 54EC by investing in required bonds. So that is what the Supreme Court says. Similar to this, there is also a Bombay High Court judgment in case of, I don't think so whether it's in this slide, it's in the case of Cello Thermoware Limited, wherein also it has been held that if you are invested into bonds, the short-term capital gain, though taxable under Section 50, but for the purposes of 54EC, it will be taken as a long-term capital asset and you will get the benefit. So there is a direct judgment of jurisdiction high court. I would now also like to bring in the question that arises. If I am not investing in the benefit of 54EC, I am not taking any benefit. I want to pay tax on that. What would be the applicable tax rate? Now, if you actually extend this logic of Supreme Court says that dimming provision are only for a particular purpose. It's a short-term capital asset only for the purposes of Section 48. That is for calculation of cost of acquisition, Section 48. And cost of index and for the computation of capital gains, which says that book value minus the consideration would be taxed. There is no indexation, there is no original cost or nothing. So it's only for the purpose of Section 48. It cannot be read into the provisions of the applicable tax rates. Now for the tax rate, long-term, if it is a long-term capital asset, the applicable tax rate is 20%. But if it is a short-term capital asset, the applicable tax is your normal slab. So if it is 30% tax rate. So what happens? If I extend this logic similarly, then because once it is a long-term capital asset, I can get a benefit of Section 54AC. Then because Section 50 cannot be extended beyond the provisions of Section 48, it cannot be read into Section 54EC. Similarly, the long-term, this asset remains a long-term capital asset, and these provisions cannot be read into Section 112, which prescribes the tax rate of 20% on long-term capital asset. There are, supporting this view, there is a Mumbai Tribunal judgment of Manali Investments, which confirms this view, which relies upon these judgments of Supreme Court and Bombay High Court, and it actually takes a ratio from that, stating that once a long-term capital asset remains a long-term capital asset, and tax rate applicable would be of 112, and you have to pay 20%. Now we are finding a lot of practical difficulties when you actually file the return, that how do the 20% of tax to be calculated? Because when you file an online return, once you fill up the sales value in your depreciation chart, the difference between the opening book value, consideration received, and the difference automatically gets taxed as short-term capital gain. It actually directly. So you are not actually, your return does not permit that. So if you want to pay tax at 20%, how do you really do it? Your return actually does not allow, though there is a judgment in your favor and you can take the benefit. So only way is, okay, you report your consideration only to the extent of opening book value and you don't show any gain in the depreciation chart. So it does not get taxed in the short-term capital gain, and you include those capital gain directly into long-term capital gain chart if you want to avail that benefit and pay tax at the 20% even on the depreciable asset. Karnataka High Court, as we had discussed, as I mentioned earlier when we were discussing, under Section 54, there was a provision which says if you are investing, you should invest in a residential house. Now, should not be understood whether signifies a singular or a plural. Was a controversial point, and the Karnataka High Court, there are also other high courts which have held that when assessee intends to purchase a single flat and alterations to make two flats as a one unit shall be considered as a single residential unit. So in case of Anand Basappa, it has to be done. Let's take I buy two adjoining flats by under the two separate agreements. So whether it would be treated as a single flat or it would be treated as two flats, because the 54 says a residential house. So once it says a residential house, whether it should be singular or plural. In this particular case, it was held that in any case, even if it is treated as singular, though it says that it should not be treated as singular, even you can buy two separate flats. But in this particular case, because the two flats were made as a one single flat, and the one single flat would be treated as a single flat, he should get a benefit of capital gains. And the benefit of capital gains was allowed. As I mentioned earlier, there is a judgment of Madras High Court on Trilokchand and Sons, which really clarifies that a cannot be treated as a singular or a plural. It can include more than one house. In fact, it has gone to a certain extent wherein land developer actually has entered into a development agreement, and instead of the cash consideration, he has got the multiple flats. So he got 6 flats, 5 flats, 7 flats. So the was interpreted in a similar manner, which it says that it cannot be treated as one, it has to be a plural, and if he has invested into a 6 residential flats, instead of land is getting 6 flats, still he will get benefit of 54. But by the recent amendment made, whereas now this has been replaced by 1, please mind it, in the future this benefit would not be available. But these were the landmark judgments which have been now overcome by the government by amending this particular act. We all know that if you want to avail the benefit under Section 54, you have to invest in the residential flat or 54 or 54F in a particular period of time. If you have not invested in that particular period of time, and if your due date of filing the return has arrived, then you have to deposit that amount under capital gains account scheme. Now the question is, at what period of time for filing the return, there are 3 time limits which are available to you. If under Section 139, you can file the return. If you are an individual, you can file the return on 31st July. Under 139(4), that is belated return, which we call, you can file up till 31st March of the next 31st March, that is before the end of the assessment year. Initially, it was 1 year after the end of assessment year. Now it's 31st March, so within 12 months. If you have filed an original return under 139(1), that can be revised under 139(5) also. So there were a lot of judgments. There are judgments of Jharkhand High Court, MP High Court, which says that the provisions under Section 54 and 54F says that deposit, if the investment has been directly made in the period prescribed under Section 139, then you will get the benefit of capital gains. You need not deposit before 31st July, that is the due date of filing your return under 139(1), because this section uses the words 139 in the upper part, and in the second part it uses that before filing the due date under 139. But 139 includes all the sections of the 139. So 139.1, 139.4, 139.5. So there were judgments of various high courts which says that if you are investing the amount within the time period prescribed, even under 139.4, you will get the benefit of long-term capital gains, and you need not deposit those in the capital gain account scheme before the due date prescribed under 139.1. Now, Bombay, this matter went before the Bombay High Court. It was a very particular matter, which says that if you are filing a return, there are two things. You may file a return under 139.4. Let's take an example. That is 139.1 due date is 31st July 2020, and 139.4 due date is 31st March 21. So, if I am not depositing anything before 139.1, I do not file return also under 139.1. Doesn't matter. But I file a return in month of September. I do not invest the funds. I invest the funds after September 20, between March 21. But I have already filed a return in September 20. What happens? Bombay High Court says that you have get the benefit till the time you do not furnish the return under section 139.4. But not before the last date of filing the return under 139.4. So though the last date of filing the return under 139.4 is 31st March 21, but you have already availed and filed the return under 139.4 on 30th September 20. So investment made up till 30th September 20 will only be available as a benefit under the capital gains. Balance you will not be available because you should have deposited those funds in capital gains accounts. That is what Bombay High Court says. So it distinguishes between two things. One is actually the last date under which 139.4 is available, and one is when you have actually filed the return under 139.4. So the important is if you have actually filed the return under 139.4, before that you should make an investment or deposit it in the scheme. If you do not do that, then you may not get a benefit. That's what Bombay High Court says. Similarly, if you have filed under section 139.1 already a return in July, which you can revise in 139.5, then to my mind it's difficult to get an exemptions because you have already availed a particular facility available for filing the return under 139. So you should have deposited that amount in capital gain scheme if the investment was not actually made. In which case you will not get a benefit up to time limit available under 139.4 or 139.5. But if you have not filed under 139.1 return itself and you make an investment before filing the return up to the last date of 139.4, you will get the benefit. That's what Bombay High Court says.
Sir, sorry to interrupt. Any amendment has been made in the section 54 or 54F, or this is
Yes,
this is still applicable, or any amendment in 54 or 54F?
This is applicable. This is applicable.
Okay, thanks. Yeah, please continue.
Then there is another judgment of Madras High Court, R.M. Sudaram. Which rules out, not only cost of construction of new property incurred after sale of old property would be eligible for exemption under 54(1), but also cost of land on which new property was constructed, even if such land has been purchased 3 years prior to sale of old property. Very nice judgment. Let us take an example. I already have a land on it. I was in possession of a particular plot. Now I sell some property today and I incur a capital gains. Now, out of those amounts, I construct a residential flat on that particular land. Obviously, within period 1 year before or 3 years, I am actually utilizing funds only to the extent of construction activity. Question arose, out of my capital gains of 2 crores, construction by 1 crore has gone, but still there was a value of that particular plot which I had acquired earlier, before the time limit of the sale of the flat. Will I get a benefit of that particular land? Madras High Court says yes. This is totally different again. It's a very nice judgment if you go through it. It says, I am getting that was only a land. I cannot, the question is, benefit is that I should have a residential house. Now, if I want to construct residential house, it cannot happen without the land. My land has been converted into residential house only within the period of time, that is 3 years after or 1 year before. And that residential house could not be constructed without this particular land. So if I want to give a benefit under section 24, I I should add up both the values. Though the cost of land was incurred 3 years prior to it, that cost will be considered for the purpose of reinvestment benefit plus construction cost. I'll add both and then I should clear. So it's a very nice judgment. Excuse me. There is a very old judgment of Supreme Court, Arvinda Reddy, which happens generally in the family settlement case, wherein brothers gets divided amongst the properties. So whether the section 54(1) should be available or not, benefit under that. In this case, HUF constituted of 4 brothers basically who were owning a residential house properties. Out of what happened, 3 co-partners released their respective shares in favor of assessing for agreed consideration. Question arose because he was getting a right because the property was owned by HUF technically. So HUF per se under the income tax is a separate legal entity. So the question arose when the 3 co-partners are releasing their respective shares in favor of the assessee. So property does now no more remains of HUF. It becomes an individual property. In the hands of the assessee who has acquired this asset from the 3 brothers, whether it would be treated as purchase for the purpose of section 54. The Supreme Court held that yes, because the assessee is one of the co-owners and he has obtained right of ownership in his favor from other co-owners, it amounts to appreciation of property and it's eligible for exemption. So it would be allowed. Karnataka High Court again on 54F. Assessee has already started construction of residential house within 1 year prior to date of sale of land and utilize entire sale consideration within 3 years from the date of transfer of land. Whether he can be granted an exemption under section 54F. So construction was started. See why this is important. If you read section 54F, it says it should be 1 year before purchase. Technically, those purchases appropriate and utilized in 2 years after or constructed in 3 years after. So word construction is used only for the word 3 years after. So the question arose that whether the construction which was actually started 1 year before the sale, whether would be eligible. Karnataka High Court says, where assessee transferred the land as an on date of sale, he was already owning a vacant site similar to the earlier judgment on which he had already started construction by availing loan from the banks. All investment made in construction of residential house on said vacant site within a period of 1 year prior to sale of original asset be eligible for exemption under section 54F. Further, assessee having invested entire sale consideration in construction of residential house within 3 years from date of transfer, he could not be denied exemption. So though the construction was started 1 year before, all the costs incurred has been eligible. So 1 year and 3 years both have counted. So actually for the purpose of construction, I have got a 4 years if you actually read this judgment. There's this Bangalore Tribunal. If you construct a residential house on the leasehold land, it would be allowable. That's there are a lot of leasehold, and I think so. There is no controversy, but somehow this controversy appeared in some particular judgment, so we can rely upon this. But there is a particular issue being faced in Mumbai also, wherein a lot of residential societies actually land is a leasehold, and you actually entered into a transferable tenancy agreement. So there are a lot of issues going on. Let's take an example. The land is leasehold for say 99 years, and I know if, in area like Juhu, Malabar Hill, this is happening, wherein what's happening is the land is owned by a society. It's on a long lease of 999 years. And actually when the building is being sold, a residential flat is being sold, that is an agreement entered for transferable tenancy. Because you don't have a right to rent per se. So those are called transferable tenancy. And it has been posted by the department before also, that you actually do not get an ownership right, because ultimately land is a leasehold. So the benefit under section 54 will not be allowed. The matter has gone up to tribunal. In case of Raj Babbar, who is a film star, of course I have not pointed out over here. In case of Raj Babbar, it has been held that ultimately you get an ownership right of the flat. A land may be a leasehold, but the flat constructed thereon remains a residential house and you remain an owner thereon till the time building actually does not come down. So if the building comes down, you may not actually have a right to it, but of course you have a possession of the land and you may always negotiate with the lessor and still construct a new building. But till the time the building remains, you are actually protected under MOFA, Maharashtra Ownership Flat Act. You should get a benefit. Then Kishore Ramanlal Parekh, Bangalore ITD, assessing did not deposit the sale consideration in capital gain account, bank account before the due date of RI, but purchased the house within 2 years under section 54F1. Whether we will get a benefit. I've already discussed, though Bombay High Court says, no, in this case, obviously, if he has not filed the return, what does the Bombay High Court says? Once you file the return, you have seized an opportunity of filing a belated return under 139(4) and therefore you do not get benefit. So it's like that. If you want to actually do not deposit those monies in the CGS bank account, then you should do not file the return itself. So if you summarize these judgments, as far as capital gains account scheme is concerned, technically you should not file the return, you should wait because you have a 1 year period up till 139(4), invest directly in the flat if possible, and then if you file the return under 139(1), then technically if you analyze Bombay High Court judgment, you lose an opportunity and then you have to deposit in CGS bank account. If you do not, you lose the exemption. Coming to development, Sanjeev Lal, a very nice judgment of Supreme Court. Very assessee having executed an agreement to sell in respect of a house property, purchase the new residential property within 1 year. Please mind it is an agreement to sell. It's not a sale agreement. Within 1 year from date of agreement to sell, or subsequently sale deed could not be executed within prescribed time due to an order passed by competent court. A valid transfer did take place with meaning of section 47 by even executing agreement to sell was to be granted to assessee. So what the facts is, assessee have executed an agreement to sell in respect of house property and purchase a new residential property within 1 year and claim the benefit under section 54, 54F, whatever it is. Subsequently, a sale deed could not be executed because it's an agreement to sell. So there was no registered sale agreement executed on. So what did the department say? What was the revenues case? There has been no valid transfer on it. There is no sale. So once there is no sale, there is no transfer, there is no capital gains, when is the question of claiming any exemption also do arise? So once there is no valid transfer, Supreme Court says, even an agreement to sale amounts to a valid transfer under section 247. And because he was restricted from a competent court for executing the valid sale agreement, he cannot be denied, or it cannot be held that there was no sale of asset, and therefore the question of long-term capital gains and the benefit under 54 do not arise. So it says, it actually, if you actually read this judgment, it extends that even the rights are very important. Agreement to sell, even if for some reason there is no registered agreement could have been entered, still you can claim a benefit of sale. And this can be extended even to a purchase, in which case, wherein it has been held in majority of cases that if you have acquired the right to purchase, like an allotment letter which we see, it amounts to a purchase, it amounts to acquisition for the purpose of benefit under 54, and you cannot be denied benefits. Cello Plus, I think so, it was here, but we have already covered 54 EC, even a short-term capital gain. This is a specific case. There was also one more issue in this particular case, that if there were no bonds, of course now it's, what happens is you have to invest in the 6 months. Sometimes there are no bonds available during this period of 6 months. So what do? Government has to come with the bonds. So when their 6 months were expiring, within the time limit of 6 months from the date of capital gains, there were no bonds available in the market, either of REC and HI. So he could not invest it, the assessee. And this matter went up to the Bombay High Court because they were denied. Tribunal allowed it, but department went to High Court. High Court said that the bonds are not available in the market. Assessee cannot be penalized for the same, and the benefit in the 54, because as soon as the bonds got available, he has already invested. So this 6 months should be considered as condoned for that period. Extended period should be condoned. Matters under 45(5) here. joint development agreements. After 45(5)(a), of course, there is a lot of resolution has taken place. The question will arise that what happens to an agreement, because I know there are a lot of litigations going on between before 2018 in case of development agreements. Now, this is a case of Infinity Infotech Parks, where assessee entered into a joint development agreement of land owned by it in terms of which a part of constructed area was to be given to assessee and remaining portion was to be kept by the builder. No transfer within meaning of 247(5) would take place until builder constructed said property and handed over a portion of same to assessee as per terms of agreement. So 45(5) is from first separately, but this judgment pertains to an assessment year which is before assessment area. When it is that till the time my consideration, the constructed property, which is my consideration, if I do not get it, the transfer will not be taking place under section 247(5). And I am not supposed to pay any capital gains tax on the date of entering into agreement. Calcutta High Court held, developer could have retained possession of land and declined to retain possession thereof to the assessee since developer was in physical control thereof. But such resistance of developer would not have been protected under section 53(a) of Transfer of Property Act. So only because I am giving a possession of land to a developer does not mean that the transfer has taken place. I entered into a development agreement and I give a possession. The right of developer to retain possession and protect such possession under section 53(a) of the Act of 1882, that is CPE Act, would never have arisen prior to construction being completed and the apportionment affected. So under 53, 247(5) deals with the transfer of property 53, and that the right transferred under section 53(a). It says, though you have given a possession, there is no legal right coming to him, and therefore that cannot be treated as transfer. So, though 45 after 45(5)(a), this litigations may go on, but even in the old cases where the litigation is going on, this judgment can come to your rescue, stating that though the possession has been given for the purpose of the construction, till the time he does not give me my constructed property, there is no transfer and there is no capital gains to be paid on till that time. Similarly, Punjab and Haryana High Court held, there was no transfer within meaning of section 247 of Income Tax Act, made with 53 of TBI, when development agreement entered into by assessee with developer for development of certain land was not registered. Now, this is a very different. In absence of registration of agreement for transfer of immovable properties, it will not have an effect for purpose of section 53(a) of 1882 Act, where assessee was member of cooperative housing society which owns certain land and entered into a DA to transfer land to developer on pro rata basis. Assessee received proportionate amount as a consideration. AO was incorrect in knowing that there was grant and assignment of various rights in property by assessee in favor of developer and same amounted to transfer by applying section 247. So, if it is not registered, now department most importantly also filed a SLP in the Supreme Court in this judgment, which has been dismissed. Though just dismissal of SLP does not amount to a ruling of the Supreme Court, but it does have a reference value that SLP has been dismissed. So it has a reference value to that extent that if the agreement is not been registered, then section 2(47) will not attach. Now, if you read this judgment and if you read the judgments which we were seeing for the purpose of section 54, which says 54(F), when it was been interpreted very liberally in favor of the assessee, it was been held that even if the agreement for sale is entered and there is no register, it would be treated as sale for the purpose of section 54 benefit. If you are acquiring a particular asset only by way of agreement to purchase or agreement to sell, I would say, or an allotment later, you were given a benefit that you have acquired a purchase for that. The most important difference, and the department is always hue and cry on this, that this both have been, the transfer has been interpreted differently when it comes to the provisions of section 54(F) and when it comes to actually levy of capital gains under section 247. It has been interpreted differently. But they fail to understand that for the purpose of section 54(F), the objective of those particular sections is that the funds which have been earned on sale of the property should be reinvested in the infrastructure projects, in the residential flats. That's the main objective. And therefore, there was a liberal interpretation has been given that if the funds have gone, and though agreement has not been entered, it's only an allotment later, ultimately I would not get that property because builder runs away and he does not construct for another 5 years, 10 years. But my intent was to invest. I have invested in for buying the residential property, so I should get the benefit under section 24. But when it comes to taxing it, the literal and the legal meaning, if you take it, if there is no transfer happening, you cannot tax under 247. Again, there's a judgment of Bombay High Court jurisdiction in case of Fardin Khan, wherein it was held where assessee, owner of a piece of land, entered into a development agreement with developer for specific purpose to develop land, and possession of land continued to be with assessee. There was no transfer. Now, in this case, it says because the possession was not granted, there is no question of 247(5) because 247(5) says that when the possession of land has been given in part performance of the contract, then a transfer will take place. In this case, possession was not given, so it says that there is no transfer has taken place, so capital gains do not occur. But if you go to the Calcutta High Court judgment which we were discussing in case of Infinity Info Tax, it goes one level further. Even if you have given the possession, still there is not a transfer till the time you receive your consideration, which was in kind. That's the most important, and that actually rests a lot of controversy down. Again, Punjab and Haryana High Court. Sorry, this we have completed. Bombay High Court, another judgment, Joa Soza program, where actual possession of property was given to a developer by an agreement transfer under section 247, would be considered to take place in year of the agreement and not in year when power of attorney was executed to give access to developer to certain jobs on same land. Now, this is very important. I gave a power of, what happens is sometimes the development agreement just makes a power of attorney and he do not get registered development agreement to save on stamp duty. So he takes a power of attorney is in favor. He pays some 10 amounts to the landowner, keep it in abeyance, gives a landowner gives a power of attorney. The question arose that though the actual agreement, actual possession of property was given, so if I just read it below the dates, it's very important. Only the agreement dated 30th April 2001 gives rise to transfer within meaning of section 247(5) attacking the capital gains tax. There was a registered agreement on 30th April 2001. The agreement dated 30th refers to some oral agreement and power of attorneys executed between assessee and developer. Now, this oral agreement's power of attorney are prior to April 2001. That is prior to 2001-2002 financial year. Power of attorney was done in 1993-94. But the agreement dated 30th April 2001 in clear terms recorded as assessee by the owner and in possession of the property. Power of attorney of the year 1994 did not disclose that possession had been given to developer in pursuance of said property. Hence, the transfer within the meaning of 247 had taken place only in assessment in 2023. So the important ratio is that just giving a power of attorney, though that power of attorney entitles the particular developer to do whatever it may be, does not amount to a transfer if the possession has not been given. If the possession has been given later on, after entering into a proper registered agreement, the transfer would be treated when the agreement is entered into and possession is granted. So possession remains an important part over here also. Of course, the question over here is not in respect of consideration. The assessee has already given offered for capital gains on 30th April 2001. So I'm not going into it that it was a cash consideration or some kind consideration which was still pending and he could have still availed further benefit till the time he could have received the in-kind consideration. Enhanced compensation, 45(5). Now, there is a judgment of Supreme Court in case of Ghanshyam Mutual. It says, even in cases where pending appeal, court, tribunal, authority before which appeal is pending, permits claimant to withdraw against security or otherwise enhanced compensation, same is liable to be taxed under section 45(5) in year of receipt. So enhanced compensation is basically this happens when there is certain disputes pending for the compensation received on surrender of land to government bodies. So if you surrender some land or whatever it is and you are entitled to a certain compensation, you receive a particular compensation. The question is the transfer of land has already taken place and you have received 100 rupees. You offer for capital gains tax 100 rupees. But you have filed a suit for 120 that my compensation should have been 120. The government has paid me 100 rupees is not correct. So this 20 rupees I'm claiming and those matters are pending before various authorities. The question arises that what should be my value of capital gains tax? When should be this 20 rupees tax? When should be 100 rupees tax? Obviously 100 will be taxed. So this enhanced compensation, if it is received later on, would be always taxable when it is received. On the receipt basis, that's what the Supreme Court says. So Supreme Court says enhanced compensation shall be taxable even in case of appeal against such compensation. If such compensation is received by asset during such against the security provided by it. So it would be taxable when it is received, even if the appeal is pending. So though you are claiming it, that does not mean 120 has accrued to me today. I'll pay 120, though I filed an appeal, I'm claiming it further and did not offer for tax on the date. It will be taxed when it is received. Capital gains matter related. Electroplast engineers, Bombay High Court. This has will discuss certain capital gains matters related to partnership firms. Day in, day out, we keep on reconstituting partnership firms, and it's how does the taxability take place? We all know there is a provisions of 45(4). So rather than going provisions, there are certain very landmark judgments which I would like you all to take a note of it. Bombay High Court in Electroplast engineers, where retiring partners were paid sums on reconstitution of assessee partnership firm in proportion of their share in partnership business. No transfer of assets being taken place, no capital gains would arise. So I reconstitute a firm. We have 4 partners. We hold a lot of assets into that particular partnership firm. 2 partners are retired, another 2 are added. So I am being paid my share as a retiring partners. Question arose, whatever amounts which retiring partners have received, whether they would be chargeable to capital gains tax, whether it would be treated as transfer of assets. Bombay High Court held, where original partners retired and new partners constituted business of firm, and firm assets were revalued. You are also revaluing the assets so that you can credit it to partners' capital account, and they can withdraw an higher amount. Technically, this is happening. Actually, if you see, everybody knows it is in the commercial parlance, it's a transfer only actually. But under the income tax, it's not a transfer because firm is a separate legal entity. And retiring partners were paid sums as per their share of partnership asset. Then there was no transfer of capital asset by way of distribution upon reconstitution of firm and making payment to retirement firm. Hence, the same paid by assessee firm to retiring partners would not constitute a capital gains. I have a capital, I'll just take it with an example just to clarify because it's a very important issue. There is 100 rupees capital, 100 rupees land appearing in my books. 4 partners, 25 rupees each. Now this 100 rupees land is worth today 1000 rupees. So I revalue this asset at 1000 rupees. And the revaluation effect is obviously given to my partner's capital account, which from 25 rupees goes up to 250 rupees each in 4 accounts. Now 2 partners goes out and 2 partners new come in. So what all the existing partners pay this outgoing partners on 500 rupees. They go out and only 2 partners constitute and continue the business. So now practically the asset is in control of the partnership firm, owned by a partnership firm with only 2 partners having a capital of 500 each. So this particular partners are getting 500 rupees, 250 each. For the amounts invested only 25 rupees. So that is what is hurting department, that why this amount should not be taxed in the hands of the retiring partners under 45(4). Whereas 45(4) says distribution and on the dissolution, whereas the reconstitution of firm is not covered under 45(4), and therefore Bombay High Court has said only on the reconstitution of the firm there won't be any tax liability in the hands of the retiring partners. Oh, I missed somewhere. Kindly excuse me, I'll just come back to. Similarly, there's a Karnataka High Court judgment which says admission of new partners and assignment of right in a firm to new partners out of rights of assessee for consideration did not amount to transfer in the hands of assessee under 247 of the Act and consequently not liable to tax under section 45. So again, the similar judgment, P. N. Panjwani, there is no provision in Act for levying capital gains on consideration received by a partner for reduction of his share in partnership firm on inclusion of new partners. On reconstitution of firm, new partners were inducted who contributed cash as their capital contribution are erstwhile partners, withdrew money brought in by incoming partners as joints. Similar facts, they continued to be partners. Since property was not owned by erstwhile partners, it could not be said that they have transferred share. Property was always owned by the firm, it will remain in the firm, and there won't be any tax liabilities. Chennai to be done. Again, similar. Additional amounts paid to retiring partners in represented share of retiring partners in worth and value of business in which they were partners. Therefore, additional payments made to retiring partners were not in nature of any profit or income within the meaning of section 28(5)(a). Additional amounts paid by the assessee were non-taxable capital receipts. So, the assessing officer being smart over here that okay, I cannot bring it into tax under section 25(4). So, any additional amount received over and above the capital should be taxed under 28(5)(a). That is a business income. Why not? No, sorry, it cannot be. It cannot be treated as a business income. It remains a capital receipt in all cases. Madras High Court. Similar. On retirement, allotment to retiring partner of his share in assets of partnership firm after deduction of liability is not a transfer within meaning of section 247 so as to assess capital gains under 45. Now, this is very different. In this particular case, you are not paying any money. If you read it, where I will just read the important facts, where there was only a reconstitution of partnership firm by retirement of two partners and admission of another partner, and the partnership firm continued. And there was only a transfer of interest in partnership assets to outgoing partner in their share. There was transfer of interest in partnership assets. Such amount does not represent consideration received by him in lieu of relinquishment of his interest in partnership assets. Hence, such settlement does not attract 45. There is no revaluation, there is no cash payment, there is a transfer of interest in partnership assets. Still, Madras High Court says that 45(4) will not apply, 247 will not apply. Quality Steel, Supreme Court. Where firm dissolved on death of one of only two partners, but business continued with one partner. There was no question of selling assets stock in trade, and therefore it was not necessary to value stock in trade at market price. So the partnership firm, due to that, has been converted into a proprietary concern. That is the basic facts of the case. Where a partnership firm stood dissolved by operation of law in view of death of one of the partners and other partners continued the business has come to an end. When a business continues, it may not be necessary to follow the market rate to value the closing stock, as there was no question of selling assets of firm, including its stock in trade. So there's no liability per se, because it has been transferred at book value. There's no sale, so there is no tax liability arise on the market value difference. That's what the quality still says, that you cannot actually consider the market value of the stock in trade. It has been transferred at the book value, and you can tax the difference between market value and book value. There is no sale per se. Moped machines, Madhya Pradesh High Court again. On dissolution of partnership firm upon death of a partner, there would be no transfer of asset as contemplated under section 247, and therefore no capital gains could be divided. Because death of partner happens under the operation of law. This firm has been dissolved on account of operation of law. Please mind it. In firm of two partners, there were one of the partner dies and other partners continues business of firm without transfer of assets, then 45(4) does not apply. Hence, there is no transfer within the meaning of 247. 44 applies on only actual transfer of assets. So, if a dissolution is done together, sitting that I dissolve asset, then the 45(4) applies. But due to death, if the firm continues by a property, by an individual, then there is no transfer of an asset. That's what Madhya Pradesh High Court says. It's quite strange, but this judgment is there in the AOSC. Applicability of section 50C, a very important law of litigation is happening. We have seen that 50C, if there is a difference between the agreement value and the consideration, you have to offer, the deeming provision says that the value as per the stamp authority will be considered as a consideration of the capital gains. Only to the extent if it is not within the range of 10%, that is 110%, for that purpose will be ignored. Now, if you read actually section 50C, section 50C applies only to land or building or both. It says a capital asset being a land or building or both. So, law of controversy as appears, What do you mean by land, building, or both? Do you mean to say right in a land is not a land? Right in a building, let's take an allotment later. There's no land or building. Whether it can be held as a land or building, a 50C can be applied even if you are selling an allotment later. I have an allotment later. I don't own a land. I don't have a possession of land. I don't own any building. I'm just transferring an allotment later whether 50C could be applied. So there are various judgments. If you see all these judgments, then to my mind, only transferring an allotment later will be taxed at transaction value and not at the stamp duty value, irrespective. You cannot bring in reckoner value because there is no registered agreement also to bring in the reckoner value. So it also gets protected over there, and plus it's neither land or building. Greenfield Hotels and Estates Private Limited, my jurisdictional Bombay High Court judgments, which says Section 50C will not be applicable by computing capital gains or transfer of leasehold rights in land and building. So if you're transferring a leasehold land and rights in land and building, it will not be. So there are a lot of transfer happening of MIDC leasehold lands. We have a MIDC in Bombay also. What happens to, and a lot of places, Delhi, Gujarat, GIDC, so what happens? Bombay High Court says if it's a leasehold rights in the land, it is not land and building. Again, it says that because 50C is a DB provision, it has to be a very strict interpretation. And if it says land and building, it is land and building. It cannot be leasehold rights in the land. So even the leasehold rights, which are in nature of perpetual rights, 33 years, 66 years, 99 years, always it can be argued that it's a leasehold land, and 50C being a deeming provision, it has to be a very strict interpretation, and only leasehold lands cannot be covered. Bombay High Court is in your support. Khoobsurat resource, very good judgment, very nice. It actually reverses what 50C wants to do it. What it says, without considering a real market price, addition cannot be made merely on the basis of higher consideration declared for purpose of stamp duty. Delhi High Court had, assessing purchases properties where declared value of property is less than stamp duty value on which stamp duty was paid for acquisition. Then the amount of sale consideration minus stamp duty value cannot be added back to assessor's income. Hence, provision of stamp act levies stamp act at predetermined rate or notified rates. Hence, where higher cost of acquisition is declared for stamp duty, assessing authority should analyze contemporary comparable sales before adopting such cost as a cost of acquisition, and without doing so, no addition could be made. So it again reinforces the High Court, and there is a safeguard in 50C also that stamp duty value is not a sacrosanct. The assessee can actually challenge the stamp duty value. He can ask the assessing officer during the course of assessment, can kindly please refer this matter for the purpose of valuation officer. District valuation officer, that is the in-house income tax, they have to give the value of a fair market value. If that fair market value is less than the stamp duty value, then the fair market value will be adopted for the purpose of 50C. Or if fair market value is still less than the transaction value, then the transaction value will be adopted. That's what 50C says. But there has been a lot of issues that even the DVOs are not able to value it properly, and there may be an issues with the valuations of DVO. So you can also challenge the value of DVO, and there are judgments where the valuation done by DVO has been rejected by tribunal. If you are able to point it out that what are the important facts which are not being considered by DVO, which he should have considered by valuing the property. So if we are able to prove, if we are able to analyze, that if you go into Khoobsurat and resorts, it says that this is not a sacrosanct. If you are able to assess, if you are able to prove, assessor is able to prove, and he is able to showcase the transactions which have happened in his vicinity are less than the stamp duty value, or my transaction value is higher than those transaction value, then this 50C cannot be sacrosanct. That's what Khoobsurat Resort says. Very nice judgment. Voltas Limited. Again, a very important, Pandora's box. Section 56 could not be applied to sale of development rights of land owned by assessor. Again, development rights is not land or building, it's a right. As I said, allotment later, which I was mentioning earlier. Now, this judgment goes up to development rights also. Now, development rights are actually been assessed by stamp duty. It has been treated as conveyance to certain extent. Whether capital asset, what does the tribunal say? Whether capital asset transferred by the assessor is the development rights in the land and not the land itself. However, Section 54C has expressly mentioned capital assets as land, building, or both, and did not mention rights. Hence, 50C stands inapplicable. So if it's not land, even a development right, you are only transferring a right, you are not transferring a land per se, 50C is not applicable. That's Voltas Limited. In fact, there is a lot of other judgments also which supports this. You can consider the classic case of Mumbai, wherein land owners are different and tenants are different actually. The property is never occupied by the landowner most of the time. Landowner is only he is given, it's occupied by various tenants, and the property is encumbered. So when the landowner actually transfers this land to some builder, who then negotiates with those tenants and enter into a development agreement with landowner after taking consent of the tenants, and when he goes to register the development rights, the stamp duty does not listen to the encumbered values. He will go based on his reckoner value. He will assess that stamp duty and levy the stamp duty. I would have bought this land for 1 crore rupees because it was full of encumbered. Landowner ko kuch milta nahi hai. Then, but it would be assessed at the reckoner value, which would be astonishing favor, which may be sometimes more than 10 times. It may be 10 crore rupees. So a lot of issues are happening in such cases, wherein the value, actual transaction value is almost 10% of the stamp duty value, and litigation is happening. This is minded. According to me, if you read this Voltas judgment, you read the Kunstler, they come to your rescue. It says that wherever there is an encumbrance, that means I am not in position to give a possession of the property. Once I am not in position to give the possession of the property, that means I have not sold land or building, because you cannot sell land or building without giving a possession. What I am selling is a right to land, a right to building, but I am not selling a land and building. There is also a judgment of Mohammed Yusuf Trust in Mumbai Tribunal, which has held that this is a right, and Section 50C cannot be applied to rights, because once you are not in possession of land and building, it is completely encumbered. You cannot be studied with the 50C violation. Gujarat High Court. Again, assessing officer is to compute capital gain taken value given by valuation officer under section, even though it is lesser than the value adopted by stamp valuation. So as I said earlier, Gujarat High Court confirms. So if your valuation, DVO value is less than stamp value, he has to take that. But if the DVO valuation is less than transaction value, then transaction value. Chargeability of capital gains. Ahmedabad to be the right to sue is a right in personnel which cannot be transferred, and thus amount received as compensation in lieu of said right is not chargeable to tax under section 445. Sum received on relinquishment of right to use is non-taxable capital receipt, as right to sue is a right of personnel, not a capital that can be transferred. There is some encumbrance in the land. Let's take an example. There's an encumbrance in my land, and I have obviously I filed some suit, because there are multiple suits going on in the real estate matters. And we entered into a settlement agreement outside. As per the settlement agreement, I decide and I agree not to sue him any further. So once I am right to sue, I forgo, I relinquish that right to sue. The question arose whether that right is a capital asset that can be transferred, and whether section 45 should be applicable, capital gains tax should be paid. Tribunal says right to sue is a personal right. You cannot transfer to a third party. Once you cannot transfer any particular right, it cannot be termed as a capital asset. There cannot be a capital gains. Only chronology would be that any amounts received on such right to sue, this right to use should be read as right to sue, please, will be treated as a capital receipt, which is not taxable. Another judgment of Agra Tribunal, acquisition of land. When land sold by associate to builder had been acquired by government and associate had received no compensation, no capital gains arose to associate even though he received consideration from builder. Very important. Land sold by associate to builder had been acquired by government. So I have sold the land and which has been acquired by government. And associate had received no compensation. A matter was still pending before the High Court. Provisions of 247.3, 247.5, that is transfer, and 45.5 were inapplicable in case of assessment. Agreement with builders was contingent agreement based on happening of events in future, and thus there was no transfer of capital asset within meaning of 247. So if the compensation is received or if the builder is able to reacquire the land from government, it was a contingent agreement. But I got an amount from the builder for as it is where it is. there was no transfer of possession of any immovable property in favor of builder because possession was already with the builder prior to entering into the sale agreement, which was acquired by government ultimately. Section 53A of TP Act had no application. No capital gain arose even though assessee received consideration in full. So in this case, because I was not in possession of the property, I could not give a possession. No transfer had taken place between me and the builder, though I had given a possession and it was in the possession of builder. Ultimately, the land was also acquired by the government. There was a compensation matter pending, but as far as relationship between the builder and the landowner was, there was no transfer contemplated under 53A, and therefore there was no capital gains excess. Bombay High Court judgment, very nice judgment. If you recollect, what happens is when promoters are nowadays selling the stake, they sell their stake, they agree to sell the stake to some strategic partners. They agree that, okay, fine, I will sell my 30% stake or I will sell my 100% business. So in that case, generally this sale of shares are exchanged. So I sell the shares, I get the consideration and I pay the capital gains tax. Now, generally in all such agreements, you will find that there is some deferred payment also, which is dependent upon performance of those companies which you have sold, which the existing promoters have sold to the new buyers, that it will perform in a particular manner in upcoming 3 years. So generally, if you see such agreements, new promoters or the new investors would always like that an existing promoter should continue for a period of 2-3 years. And to motivate him that he remains with the company for next 2-3 years till the time proper handholding is done, proper customers are transferred. He is also, there is a certain contingent deferred income fixed that if he actually works for 3 years, he achieves a particular turnover which was achieved in history, then he is entitled to a particular income. Now the question arises, because the capital gains tax on sale of shares is transferable, is taxable when it actually transfer takes place. Transfer has taken place today. I have received a consideration for the shares, say 100 rupees. Certain 10 rupees I am going to receive in 3 different installments, which is dependent upon certain contingency that company will perform in a particular manner. If it does not perform, it will not be. So I may receive or I may not receive. The question that arises, again, that contingent income should form part of consideration on the date when the sale of shares have taken place. The matter went to Bombay High Court. What did they have? It says, if you see point number 3, where agreement for no right to claim any particular amount got vested in hands of assessee in the year of transfer. Underline portion. Amounts receivable as a deferred consideration could not be subjected to tax in the year in which transfer took place, as same had not accrued in year of transfer. So when it actually accrues, it will be taxable. Now the question arises, if it accrues in year 1, year 2, year 3, whether I have to offer it again as a capital gains tax, because I would have already offered capital gains, there is no transfer happening in the next year. This judgment is there is no clarity on that. Okay, supposing I receive 100 rupees for the shares upfront and 10 rupees would be dependent, which is contingent on the performance base. This 100 rupees I have already paid capital gains on transfer. Next 3 years when I receive 10 rupees, there is no transfer. Once there is no transfer under 247, there is no capital gains tax. So how would this amount be taxed? How would it be calculated? Capital gains will be calculated. To my mind, though this judgment does not talk about, because it was only issue is whether those amounts can be taxed in the year 1 when transfer took place. It says no, it would be transferred on accrual basis. To my mind, it should be taxed in the years when it is actually received as a capital gains tax with no cost, because cost could have been already adjusted in the year 1. If there is a loss in the year 1 and still certain cost has not been allowed, that loss can be actually been adjusted in the years when it is received. This I have covered. This has come Bombay High Court judgment that like we had covered for the self-financing scheme. DDA is the Delhi Development Authority. There is also circular of the, now there is a circular received from the CPE also. In case of Delhi Development Authorities or any government, HIG, LIT groups, the date of allotment of flat has been allotted, then the construction starts. So for the purpose of computing capital gains, what should be treated as your date of acquisition? It says the date of allotment, irrespective when the construction takes place, when you get the flats and everything. This is a direct Supreme Court judgment. Bombay High Court and Supreme Court SLP dismissed. Conversion of rights. Allahabad High Court. This is a very specific case. Conversion of rights of lease in a property from a leasehold right into a freehold. So I am having a leasehold rights. I am a 33 years lessee of this property, which is again a perpetual lease. I treat myself as an owner. I enter into an arrangement with the landowner, who is the lessor, and I acquire a complete freehold rights. I complete the complete land ownership rights. What happens to this? Whether there should be any charge of tax on that, or what happens is, because I may not be paying the same value for that. I may not be paying anything to it, or I may be paying the value of difference between leasehold and freehold is its value increasing fair market value from 100 to 300, but I'm paying only 10 rupees and I'm getting the better title. So what happens to it? Into freehold only results in improvement of his rights over property, and it would not have effect on any taxability of gain from such property which is related to period over which property is held. So what it says, there will be no taxability for any benefit that has occurred in the value of the property because of conversion from leasehold to freehold on the date of conversion. This value has nothing to do with the holding period of the property. This is only an improvement, right? So there will be no tax on such conversion. And I will also get a benefit from the date of acquiring the leasehold right. So I also get a benefit from long-term capital. B.A. Mota Textiles, Bombay High Court. Capital gains under section 46(2) had to be computed by taking cost of acquisition of shares in hands of previous owners. Transfer of shares by a family managed limited company, even if through a family arrangement, is liable to capital gains tax. Now, there is a lot of controversies in this. I will read the facts first. Where assessing company was under control and management of members of family. Family settlement through court required assessee to transfer shares held by it in another company in favor of second family members. So there was a family settlement, wherein certain shares were transferred within the family members to another. Assessee claimed that such transfer of shares was done in pursuance of family arrangement settlement. No capital gains would be attributed. Assessee company, since assessee was a separate legal entity being incorporated as a limited company, transfer of shares by assessee company did amount to a transfer and would be covered under section 42, 47 and thus accessible to capital gains tax. I'll come to you. Generally, family settlement agreements wherein the assets are exchanged. I may transfer certain company shares to another family member. So my brother may transfer the another company shares to me. The courts have held that these are not taxable transactions. If you see that, what is the difference between this? What does the Bombay High Court says? Those actually applies in case where the family individual members are transferring amongst the family, and that's part of family settlement. In this case, what has happened is the particular assessee company was under the control of a particular family members, and that assessee company was to be put under the control of other set of family members, and therefore transfer took place. The transfer was done by the company per se. Company had transferred those shares. So company is a separate legal entity. It cannot be considered as a part of family. That's what Bombay High Court said. If the company pursuant to a family settlement, if the promoters of those companies and other various companies decide to transfer certain shares from the hands of the company who may be holding shares in associate companies or private limited companies, this particular Bombay High Court judgment says that it would be taxable. When under a common belief, we have been given to thinking that the family managed family settlements are not taxable because there is no consideration. There is only an exchange of assets which is happening, and it's purely a capital receipt. So there can be no capital gains accrued. But Bombay High Court says, pursuant to a family settlement, if any private company does a transfer, it will be taxable. Please. Bombay High Court, another judgment. Sum received on settlement of case of property unsummed by relatives was taxable as a capital gains. In this case, assessee was a power of attorney holder to an NRI, and immovable property was owned by such NRI. He was a landowner, along with other co-owners, was unsummed by her relatives. Such NRI and other co-owners received amounts on settlement in civil suit filed by it. Merely because said dispute regarding immovable property involved some family members, and such dispute was ultimately settled by filing consent terms, the same could not be filed as family settlement and could not be held at consideration received as a result of such settlement did not constitute a capital gains. So there was a property which became an encumbered. I am an owner. Some relatives have unfaithfully unsubbed the property. They've taken a possession of property. Ultimately, we entered into a settlement agreement. He pays me an amount. I relinquish my rights in their favor. So the question is, because I am relinquishing, it will be a capital gains. You cannot say it's a family settlement. Family settlement actually means there is an exchange of property. There is no consideration flowing. In most of the family settlements, you would see that the properties are exchanged among themselves and only the differential amounts are settled. So you cannot equate such transactions with a family settlement. That's what Bombay High Court says. Rummy Investments, Gujarat High Court, where a holding company by virtue of being a shareholder receives assets on voluntary liquidation of its subsidiary company, the value of assets received by holding company on date of distribution is thus liable to tax under 46(2), and thus 47(3) would not apply to such transactions. However, capital gains under section 46(2) has to be computed by taking cost of acquisition of previous owner. So any asset received by a holding company on the liquidation of its subsidiary company would be liable. There would be no exemption available under 47. It would be liable for the purpose of he will get. It would be a capital gains. So he can take a cost of acquisition which was that of the in the hands of the subsidiary company. So if the subsidiary company had acquired an asset of 100 rupees, on liquidation it transfers an asset to an holding company, there would be a taxable event occurring. Cost of 100 rupees in the hands of subsidiary will be taken as a cost of acquisition in the holding company and the capital gains will be based on the fair market. Carestream Health, ITAT Mumbai, a reduction of capital. This is again a very nice judgment because again it's a different thought process. A reduction of capital results in an extinguishment of rights in the shares and thus amounts to a transfer. Even if a percentage of shareholding remains unchanged after the reduction, loss arising from a cancellation of shares is entitled to indexation and thus allowable as a long-term capital loss. What is happening is, as you know, there may be the shares of the company which has lost its book value. I acquired that particular share for 10 rupees per share. It does not have value today. It's worth zero, nothing. But I can't transfer it unless and until I actually transfer it, really speaking. There is no capital loss can occur. And I also tend to lose on tax benefit, which is available by way of capital loss, which I can adjust against other capital gains. So what would be the mechanism? So one associate did a reduction of capital. If you know that a capital can be reduced, so your loss can be wiped off. Your loss is wiped off against the capital which is issued. So on the reduction of capital, if you are holding 100 shares and there is a loss of your capital is already wiped off to the extent of 90. If you go through a reduction of capital exercise through an NCLT, then your share capital will come down from 100 to 10. So this 90 rupees, which is the loss. So your shares which we are holding 100 shares, now you are getting only 10 shares. So 90 shares have been extinguished. So Mumbai bench has recently held that this extinguishment of rights will be treated as a transfer under 247. Falls within the definition because 247 includes extinguishment of rights. And by way of after indexation, whatever is the loss would be an allowable capital loss. So reduction of capital permits it. But if you just keep holding those shares and if you just write off in your books of accounts, you might please bear it in mind, you will not be allowed that capital loss. But if there is an extinguishment of right and those shares are cancelled due to reduction of capital exercise, then you can get the loss back. Pune Tribunal, HYD Engineering, cash assistance and duty drawback claim received after taking over of entire undertaking by assessee is the nature of realization of actionable claims, hence capital receipts, and not a business income. So there was certain pending cash assistance and duty drawback to be received for a particular assessee. Assessee took over the complete entire undertaking, like generally there is a slump sale. So I took a asset or I bought out of the company. But there was certain cash assistance and duty drawback pending over there, which is received after that particular takeover is taken and it is received in his capacity. So whether those can be taxed as a capital gain or a business income, the question arose. It was held that it's a capital receipt. because it was an actionable claim which was realized. There is no transfer of an asset. There is no way it was connected to business before, because before I bought this undertaking, I was not into a business. So it's not connected to my business. There cannot be a business. Samit Patel, Ahmedabad Tribunal. Assessing officer made addition to income of assessing individual towards long-term capital gain on sale of properties, since assessee had only signed those documents by virtue of power of attorney executed by two individuals, NRA, SNB, who were the original vendor of and said property did not would not be taxed in the hands of us. Sometimes it's like if a power of attorney holder executes, he's only a trustee of a owner. So it's very clear that only owner can be taxed. Even if I am as a power of attorney, I execute the document and I mention my PAN number. Sometimes it happens that in the air information, my PAN goes as a power of attorney holder, and there is an inquiry being initiated and capital gain is tried to be assessed in my hands. So the question is, Ahmedabad Tribunal says, obviously, it's a well-known fact that power of attorney holder is only a trustee, and he cannot be taxed for the asset which is not owned by him. Is acting on behalf of the owners. I'm trying to cover now, of course, I've tried to cover most of capital gains on the real estate side, other matters, 54, 54F, 45. The most, which is now matter of hot discussion, keeps on going, is capital gains versus business income in case of shares. There is a lot of litigations happening that if the shares are held for a period of less than 365 days, even beyond 365 days, there were such a dispute in last 8 to 10 years I have seen that assessing officer always wanted to assess it as a business income based on the volume of transactions. And then the Bombay High Court in Gopalpur, it came with the various guidelines. And there were various other judgments, and then ultimately a CBDT circular came in that if the shares are held more than 365 days, then the assessing officer should, and if it is classified as investment in balance sheet, then assessing officer should accept it and not dispute it. So the dispute is over as far as 365 days. More holding period is more than 365 days. But there remains still a lot of dispute when it is less than 365 days. Though I am classifying as an investment, my intention is to hold it as an investment. It's my own funds. I fulfill all the criteria prescribed by CBDT circular, but still assessing officer sometimes feels no, because of the volume of transactions, because of nature of transactions, second days, 100 days, 20 days, 300 days, varying number of days, they take a decision and they make a dispute. So there are certain judgments on this which I believe would be relevant if you can just make a note. Hardik Bharat Patel, Bombay High Court, where assessee sold shares after holding them for a period of more than 12 months. He had an option to do profit earned on sale of shares as a long-term capital gain, and it made no distinction as whether investment in those shares was made out of his own funds or borrowed funds. So this is an old judgment, please mind that. This is before the CBDT circular came in 29 Feb 2016. 29 Feb 2016 says that if you are holding more than 12 months, assessee had an option to treat it, which I just mentioned about this circular. Of course, this judgment pertains to an assessment year before that circular came. But this circular has been interpreted, and even on the pending matters, it has held that once you hold it for more than 12 months, and it's my option, if I'm treating this as an investment, assessing officer should not host it. So as far as long-term capital gains is concerned, I think so. After this judgment and this circular dated 29 Feb 2016 and this judgment, it clarifies all old pending matters that all more than 12 months holding period, wherever it was held that this is a business profit, I think so it cannot be held. It will be treated as long-term capital gains. Another Bombay High Court judgment. I'm concentrating because there are so many judgments. I'm concentrating on few of them. That too of jurisdictional right, where assessee had purchased shares out of his own funds and held them for over 17 months against locking period of 1 year before sale, and in earlier years, assessing officer has accepted sale consideration from sale share of shares to be capital gain. Profit of shares by assessee was to be treated as not business income. High Court of Bombay held that. By not utilizing the any borrowed funds where assessee purchases shares and hold them for 20 months before sale against locking period of 1 year. And where AO in earlier years has accepted sale consumer of sale of shares to be kept, then on facts profit of sale by others to be treated as long-term gain and not. Now this is a very different case. I am holding for a period of 17 months. I have my own funds. which fits into as a circular. Generally, anybody would like to offer it as a long-term capital gains. But the assessee wanted to offer this as a business income and not as a long-term capital gain. Maybe because he may have some business losses, also some trading losses, so which would give him a set off against that. Bombay High Court, sorry, this cannot happen. By not doing it will remain as a to be treated as a long-term capital gains because it was not from a borrowed funds and it was used for more than 12 months. It were held for more than 12 months, so it will remain a long-term capital gains. This can be used by us when we are also claiming a long-term capital gains. When some assessee is claiming a long-term capital gains and he does not have his, he uses his own funds, there are no borrowed funds, so it helps in that case. Where assessee a medical practitioner by a profession, so it's a profession, it can be CAs also, use interest-free funds obtained from her father for purchasing shares and had shown shares as investment in balance sheet. And further, in case of fall in value of shares, same was not claimed as business loss. Profit arose on such share was treated as capital gains, not a business income. So it's my own funds because it's a father's funds. It's not a borrowed funds. It's interest-free funds. I have classified as investment in balance sheets. I have not booked loss on mark-to-mark basis and claimed any loss because if I would have held as a stock in trade, in case of loss in value of the shares on a notional basis, on mark-to-market basis, I would have allowed as a business loss, which has I have not claimed. So in all cases, it should be a business income. Further, most important, if you go below down, if it says that in this case, assessee had also all intraday transactions were declared as a speculation profit. So all intraday transactions were declared as speculation profit. So assessee was herself classified it had made two different portfolios. One is an investment portfolio and one is a business portfolio or a speculation portfolio. And she has kept the separate records in this particular case. And therefore, she was given a benefit. So thank you very much. I've tried to cover all the major judgments. And Aditya, we can take questions now if any questions on that.
Yeah, questions are there. Amish would some announcement to make, Anish?
First, we'll take the question. One minute. The one. The first question is from Dinesh Agarwalji. Can an assessee make investment in new house property till filing of return is extended period without depositing the proceeds into the capital gain account scheme? Can an assessee make an investment account scheme for availing exemption under section 54?
Yes, according to me. Can you hear me?
Yes, yes.
Yeah, yes.
Yes. So according to me, yes, you can make it. See, the only thing is, as I mentioned, the Bombay High Court distinguishes that you should not have filed the return. If you have filed the return and if you are investing in the period after that, though your period under 139(4) has not expired, but you are investing thereafter, you should be allowed. So if you have not filed the return and you are availing your benefit, you are keeping directly investing in the flat for the 1 year period and you file the return on last date, that is 31st March under 139(4), you will get the benefit.
Okay. Next question is from my side only, sir.
Yes, please.
In case of redevelopment of society, if owner surrenders the rights for the new flat with the builder, and suppose if builder is giving the flat after 5 years, so the assessee surrendering the rights to the builder will be termed as a capital gain or not? First thing. Second thing, any extra area or any amount given by the builder will be charged as a capital gain or not?
See, question is, if you are a residential apartment owner, and technically if you are transferring and you're getting a new flat of whatever size,
okay,
it's an automatic, there is no tax because you have invested it, it becomes a capital gain tax at one place, number one. And number two, you're getting a new flat in place of that. So there is also a reinvestment which is happening. So your consideration for old flat would be equivalent to the value of the new flat, basically. So your consideration and reinvestment are the same amount. So in any case, it cannot be taxed, number one. Number two, in case of society redevelopment, wherein you have got an extra area, there is judgment of Bombay High Court, which says that this extra area technically is not conferred upon you because you hold the property. This extra area has come to you because change in development control rules, DC rules in 1991. There was some DC rules and wherein the FSI was taken. So this is a capital gains which has no cost, and therefore there can be no capital gains tax in the hands of the assessor. Therefore also, so either way, so even if according to me you should not offer for tax only, and if you offer for tax also, then your reinvestment and your capital gains calculation would be similar, so there won't be any tax.
Okay. And in case of amount, we are getting any additional amount?
See, if you are getting anything through corpus, it's not taxable again because it will form part of consideration or a capital receipt, as I mentioned, number one. Number two, if you are getting any rent, and rent, if you are not actually incurring any expenses for alternate accommodation, that would be taxable.
Okay. Thank you.
Yeah.
Next question on matter, sir. 1 minute. It's again from I think so Dinesh Agarwal ji only. On matter.
Same query.
Same query, hai na? Okay, fine. Then we can go for the Mr. Subhash Agarwal ji. A client earned a capital gain on sale of land in 31st March 2010 and filed the ITR and paid self-assessment tax on time. He has not invested any money in capital gain scheme account by due date of filing ITR for 31st March 2019. Now he wished to buy a new house in June 2020 and wants to file the revised return of 31st March 2019 within extended time of 30th June 2020 by our FM and claim a refund of tax already paid with ITR 31st March 2019. Can he do so?
He should do it. Perfectly correct.
Okay, he can do it. Fine. Next question was Mitesh Chheda. Mitesh, can you, it's an incomplete question actually.
Mitesh is online.
Hello.
Actually, his query was for FMV. Now the section has been amended, 50C or something. So that's a part question. Yeah, he is there online. Mitesh?
Actually, he is not responding, I think so. One more query from Subhash Agarwal ji. Date of acquisition or a capital gain on sale of any immovable property is treated on which date? There are the 5 options. Date of allotment letter against the payment of token money, date of signing of agreement for sale, date of registration of the agreement for sale, date of process of part payment, date of possession on full and final payment.
As I mentioned, for the purpose of, there are different views which have been taken as far as date of acquisition or date of sale is concerned. When you come to date of sale, you have to interpret provisions of section 247(5). And for the purpose of date of purchase, that may not coincide sometimes, because date of purchase generally has been interpreted when you acquire rights or you want to take benefits under section 54 or 54F. So at the different ways, there has been a different type of interpretation. And it could be any one of them, I would say, for that matter, because it's very strong. Like, let's take if I'm acquiring a particular asset and I want to take a benefit of under section 54, even a date of allotment is sufficient for the purpose of claiming benefits as far as purchase, and it would be treated as a purchase. But in a technical terms, if I'm selling a date of allotment, if I'm a builder, if I take it from a reverse way that I'm giving an allotment later, would it really amount to a transfer to what is according to me? It does not amount. So it may be treated as a purchase over here, but it may not be treated as a sale. So every date of signing an agreement to sale, in any case, if I go to a second point, date of signing of agreement for sale, date of a registration or date of possession on part payment and date of possession. If you go to point number 5 of the Subhashji, date of possession on full and final payment would be the most relevant thing in this particular case. If you want to pay tax on 247.5. So even if the agreement is registered, consideration is not received, possession has been given in a part consideration, but the consideration is not sure, you can postpone up till the consideration is completely received. So point number 5 would be the best situation, and you will get a good support for the various judgments also. Yes.
Okay, the one more question from Fredli Patel, FB Patel sir. The SEC got the allotment letter dated 15/4/2014 and agreement executed on 16th August 2016 and got the possession was received on 5th August 2017. SEC sold its flat on 16 December 2018. Whether it is a long-term capital or short-term capital gain?
Long-term capital gain.
Long-term capital gain, yes.
From date of allotment.
Right.
Though, see, again, I'll make it very clear. There's only one judgment against you, I don't remember, which says that once the allotment letter has converted into a possession, you take a possession. So your right has converted into a flat. So these are two different capital assets. First, there was a right which you were holding between 2014 to 2017. Then you get a possession. And flat you are holding from 17 to 18 only. So this is, right was a long term. But now because you are selling the flat, it's a long term. It's a short term. There's only one, but there are various judgments which says in this particular case, you should reckon the date from 15th April 2014. So for me, if you ask me, it's very clear, you should get a long-term capital and indexation from 2014 for all the part payments made. Yes, please.
Okay, now the actually query is over now.
Lalit Bajaj sir has joined.
Okay.
Bajaj sir has joined, the chairman. He has joined the meeting. So if there are no further questions, I think one question is remaining. We'll take it afterwards. First, we'll welcome CA Lalit Bajaj sir.
Thank
now
you.
We cannot actually clap for hands or something. We can stand up. But thanks sir for joining at very short notice. And he's chairman, current chairman WIRC, and he's also in this coronavirus doing very active on the webinar front also, and doing a lot of webinars on each and every topic we can say he has been covering. So we have invited him. We'll ask him to share his view forward on his thoughts, and over to Lalit Bajaj sir. Thank you.
Thank you, Aditya. Convener Aditya Maheshwari, Deputy Convener Amish Sanghoi, Anisa and Utkarsh, coordinators for today's program, seniors, participants and friends. I am really thankful to you for giving me this opportunity to have an interaction with you. And I am fortunate that I am interacting with you in the presence of an expert on the subject, Piyush Chhajed, who is a very dear friend to me. And looking at the subject which we have kept in today's webinar, I believe that this is very apt for the participants of the study circle. And the reins being in the hands of Piyush Bhai, I believe that all the members must have really been enlightened on the subject.
So just a request, you can just do the correct. Yeah, thanks.
Yeah. So just a couple of things as far as WIRC is concerned and what do we expect from study circles. When initially really it was very heartening to hear that study circles will not be able to conduct any of the programs. We at WIRC tried a lot with ICAI and tried to convince them that study circles need to conduct programs because many members are really dependent on the events conducted by the study circle. And it is an appreciable step from ICAI that they have finally allowed the study circles to conduct the event. And at the same time, WIRC and branches were also allowed to conduct programs allowing virtual CPE, because previously we were allowed only unstructured CPE. So a common concern which came to our mind was, because ICAI has allowed us to conduct free programs also, but we were in dual opinion whether we should conduct free program or we should charge. But seriously speaking, looking at the interest of the study circle and their operations and the members attending study circle events, we thought that if we keep free programs, then really it would be very difficult for study circles to run their events properly. So finally, we decided that at WIRC, we will charge for each and every event, so that all our study circles and branches can run their activities properly and members can really participate. So that was one of the things we tried to cover up the activities of the study circle from the perspective of WIRC. One more thing which comes to our mind back and again is that during this scenario, wherein the cash flow of the companies whom we are providing services, and at the same time cash flow of the chartered accountants who are into practice is really little bit disturbed or unorganized, wherein the cash flow is not in such a way that we are free to invest wherever it is required. I mean to say that when lockdown started, we all were compelled to work from home. And to work from home, we required to invest on some of the applications of softwares, which really enables us to provide services to our clients from remote places. So with this idea, we at WIRC are trying to tie up with some of the companies who have developed apps and softwares which are really usable with large number of chartered accountants, not with a specific group of people. So we are in the process of identifying such products, and we will enter into an agreement or say tie-up wherein we will be able to give such kind of products or provide such kind of products to members at a really very discounted rate. For example, ICAI had entered into an agreement with the Tally, which is available for all the chartered accountants at a very discounted rate. So we are at WIRC are taking this initiative, and I would request all the members here that if you come across any of the company wherein the app or software is very much usable to chartered accountant, and if you feel that that is very relevant, and if you can help us in tying up with them, please take the initiative, come in contact with us, and we will ensure that we can give best of the services to our members. This was one of the things. As far as publications of WIRC is concerned, all the publications of WIRC are freely available on the WIRC website. You don't have to pay any rupee for that. You can go visit the WIRC website and use the publication. There are several publications of last year, current year, and previous years, which is really freely available. And let me tell you one thing, all the publications are very relevant as far as our day-to-day practice is concerned. Now coming to the activities of study circle, Aditya, Amesh, and my elder brother Radheshamji, who has always been in touch with me, I believe that with their leadership, study circle is doing a lot of activity, and they are ensuring that they can cover a lot many things so that the members can get best of the things from study circle. One thing which I wanted to state here is, at study circle we are trying to do the best, but one thing which I really feel from bottom of my heart is, every study circle has a huge resource pool as far as sharing knowledge is concerned, and as far as bringing on board some of the resources which are really very good for study circle in learning their activities is concerned. So I would request the study circle that just ensure that you are consolidating all the resources of your study circle and put them on the board so that the larger purpose of study circle and ICI is served, because we are in the process wherein we are looking forward for newer and newer resources to be developed from the bottom of the hierarchy, which can really be pulled up at the top of the hierarchy. They can be well tested at study circle, then tried at region and branches, and can be a really good asset for the whole professional fraternity. So I believe Aditya and Amish are really capable of doing so, and hopefully the leadership might be changing in short time. So whoever will be coming will ensure this. So just ensure that all our resources are really put to use at study circle. One more thing which I wanted to convey to the study circle is, See, we have been doing lots of activity as far as GST, income tax, or say corporate law is concerned. But one more very emerging area and very relevant area which has come in front of all these other activities is awareness about the relevant technology and use of technology for running our practice and growth in our practice. So I believe that it is our responsibility at Study Circle to create this awareness and education among all our members about the technology which is usable by all the members. So I would request our study circle team that do plan some of the events which are really relevant as far as technology is concerned, so that we can enrich our members on that front also. One thing which I wanted to state here is, it happens that at times a particular subject we feel that is not generally relevant to members. Say for example, if we talk about project finance, if we talk about forensic audit, it might happen if we talk about MSME provisions, it may happen that generally the members are not much interested. Out of the total number of members, only 20-25% of the members are interested on the subject. So we are of the opinion that boss, yes, subject pe apne ko response nahi milega properly. But I strongly compel the leadership at the study circle that try to ensure that if there is any subject on which some of the members are interested, the study circle has a moral and a principal duty to conduct a program on the subject, so that we can provide wholesome services to the members of the study circle. We don't have to stick to the common or say popular subject. We have to cover the subject which are not so popular but relevant to a particular group of chartered accountants. So this was one of the area which I wanted to share with all of you. One initiative at WIRC which we are taking ahead this year is, we are looking forward to come out with some of the reading rooms for the benefit of members and students. I would request the study circle that if you come across any of the premises which is freely available to us, as far as infrastructure and maintenance is concerned, ICAI is ready to take the responsibility, but to pay the lease rental for the property, ICAI will not be possible to pay. It will not be possible for them to pay the lease rental, because in that case lot many permutations and combination arise. So if you come across any premises which may be available for ICAI for running its reading room, so I would request the study circle that please come ahead and just share it with us, and with your help we will take it ahead and ensure that how best we can provide services to our members and students. We are just moving ahead and we will be facing 21st June which is a International Yoga Day, then 1st July which is CA Day. ICAI is running an activity on 29th, 30th and 1st of July for CA Day, wherein we all be involved in that. And little scope is there for study circle to conduct any of the activity as far as 1st July is concerned. But 21st June, study circle can plan a virtual yoga program at WIRC. We are planning to participate in that. And for 1st July, if you can plan flag hosting, that would be great. I would request that if the members of the study circle can individually commit to plant a tree on 1st July from the respective place or from the respective resources, it could be a great contribution to the economy and from the perspective of the whole fraternity. So this initiative, if your study circle can take, would be very great. Lastly, we have just the most awaited program is starting on 20th of this month, that is DTRC, Direct Tax Refresher course. I would appeal all the members that those who are interested in participating and have not yet registered, do come ahead and register. It may happen that we might have to close the registrations because of the limit of the participants which we have been given by ICAI. So those all who are interested, please come ahead. We have a refresher course on international tax and transfer pricing starting on 25th of June. Please come ahead and do participate on that. We have recently come out with an e-publication on Vivad Se Vishwas scheme, which has been the real hard work and contribution has been done by Piyush Chhajed ji. And through this forum, I would really heartily give a thanks and be grateful to Piyush ji for really contributing for such a noble initiative for the use of all the members. The e-publication is freely available on the WIRC website. As I have already told you that all the publications are there. It was just to give regards to our speaker who has really come ahead and contributed a long way in coming out with this publication. This was all from my side. Thank you for giving me this opportunity, and looking forward to interact with you personally when I get an opportunity to come to your study circle and talk to you personally. Till that time, continue with your learning process and continue to be dynamic and do what all activity you can do. WIRC will be of the utmost help, and help at the bottom of the activity of the study circle. You don't have to worry as far as study circle is concerned. We are at your place. Whenever you need any help, do call us. We will be really fortunate to be of any help to you. Thank you once again, all of you. Thank you.
Thank you.
So thank you very much for your kind words of wisdom. And we'll also like to point out that WRC members are just a phone call away. We can just say anytime we have any doubt, Lalit Bajaj sir, anyone from the council, they're just a phone call away. So we are like friends. We can already start whatever issues we are facing. So they are really, and kudos to them also. So being available and with balancing their work-life balance and the time to the council. And also congratulations to Piyush Chhajed for completing that book on the publication from WIRC. And we will look forward whatever suggestions we have given, Lalit Bajaj sir, for the new team which will come in next week to take care of that. And we'll definitely work upon whatever this has been done. So Amish, you want to say something? Join.
It was a very short notice given to the Lalit sir, and he had accepted it and graced the occasion. So I thanks to you, sir. Now we can, Anisha ma'am, we can close. Any
Only
other query?
Shrikant Maheshwari had one question, I think. That was the
Okay.
last, I think. But he is there. Or anyone wants to raise any question to Lalit Bajaj sir also, there he is there. If anyone wants to raise any question or some problem, issues faced in any.
Aditya, there is a comment on your chat about plan a program on cloud, on the subject which is related to cloud. There is a message on the chat. If you can just answer that.
Because we have already kept on something on last year, we had already kept a meeting on blockchain and everything. We'll keep that. We surely keep that meeting in the near future. So if anyone wants to raise anything, speak with Lalit Bajaj sir or ask something, he's there. Otherwise, we can then take up last query and we can close the session. Whoever wants to say something can raise their hand and then we will unmute you. Nikhil Porwal.
I have responded to Shrikant on chat.
Okay. Great. Nikhil Porwal wants to say something.
Aditya, you can hear me?
Yeah.
Yeah, Lalitji, just one question is that since everybody is thinking of going on the virtual mode and everybody is trying to locate virtual cloud providers, why don't ICAI look into like how you have been looking into providing for Tally and other softwares? Why not a virtual cloud provider having a tie-up for all chartered accountants at a discounted rate so that we are all taken care of by one person and it is secure and it is cheap?
Yeah, very relevant point has been made here, and I would like to share here that we had a coordination meeting with all the branches, and wherein Vice President sir was there to address all the doubts and issues of all the branches. So one of the point which was discussed there itself was the same point which has been highlighted here. And Nihar Bhai has very specifically told us that he is going to take up this issue at ICI and he will ensure that whatever best we can do, we will do that. So we are also looking forward for some positive outcome from ICAI.
Okay, thank you, sir.
You can always have a big bargaining power then from the software providers.
Yes. What is our next query?
No, queries are already answered.
Answer. No. So Anisha,
All.
can you take for the vote of thanks? One minute. Anisha not audible. Wait.
Not audible on.
Yes, Anisha, you can speak. Anisha not audible. Not audible. Aditya, you can take for the vote of thanks.
I think you can also. So I thank CA Piyush Chhajed for coming on a Sunday morning and taking us through a marathon. It is very difficult, I think, for speakers also to be facing saying and one side whether the people are listening or not, and they have to physical interaction. This is the difference, that we can also ask question in between, but this is the only drawback I can say for this program. And he has very well explained gone all through all the various sections, latest judgments, and so I thank him on behalf of Andheri Oshiwara Study Circle, and with a loud applause he can just have. And I also thank Lalit Bajaj sir, chairman, for coming at very short notice and guiding us. Our members are the incoming team on a Sunday morning, and we are disturbed in a lot to please join the session. And he had obliged, like always, they are always there for us. So we'll close the meeting.
Yes.
Thank you all the members.
Thank you, sir. Thank
you
all the
members for
audience.
joining.
Thanks.
Yeah, thanks. Thank you. Lalit Bajaj sir has left, I think, already. Thank you.